What's the difference between paying a fee and paying a fine? The answer to this question may not be as small or insignificant as we're inclined to believe. I recently picked up the book, The Psychology of Money by Morgan Housel. It lays out some valuable concepts and ideas about investing and managing our finances, growing our wealth. But there's one idea that I wanted to share because, yeah, from an investing standpoint, it's important, critical even, but it's relevant to so much more. And I think an understanding of it will help us in many aspects of life. So first, let's start with the financial piece, and then we'll sort of grow the metaphor, right? Because Housel talks about how we should look at investing in the market. And one of the hardest things for us to deal with is the market's volatility, right? It's difficult for us to invest our hard-earned money and then see the market go, let's say, for example, down 20%. Like seeing that huge dip in our investment, that's not fun, right? Everyone knows that. That can be nerve-wracking. And it dissuades a lot of people from investing or keeping their money in when they should. It ultimately keeps them from getting the returns available to them, right? But here's the point he makes. He says those people who see that volatility as a fee and not a fine are more inclined to win in the long term. Understanding that market returns are never free, they demand a price. And that price is the roller coaster ride we all have to deal with. That is the market. It's the ups and downs and highs and lows. That volatility is the cost of admission. And if you understand that, you're more inclined to stay calm. Keep your long-term vision. You're more than likely to come out on top. On the other hand, if when that turbulence arrives, the sudden crashes, the ups and downs, and you see it as a fine, as this terrible thing that's happening to a punishment, you're more likely to act emotionally, to be reactive and make decisions that aren't in your best interest. To drive the point home, he mentions Disneyland, for example. The fee is $100, and people will gladly pay that fee because, they get that great experience with their family, their kids that they'll have for the rest of their lives. That $100 isn't a fine. It's not a punishment. It's an intentional, deliberate trade of one thing for another. And if you were to look at it as a fine, you'd never get to enjoy that experience. If you thought that $100 was a punishment, it just wouldn't be the same, right? And so why do I bring all this up? Because I'm a firm believer that the best things in life all come with that price, or a fee, as Housel states. But I also think we sometimes have a tendency to look at that cost, that very same cost of admission, as a fine, as a problem. When really, no, it's just trading some turbulence now for a reward a little bit down the road. Sometimes the right thing is the hard thing, the uncomfortable thing. With dividends, it will pay so long as we understand that it's opening the door to something greater. Leaving a situation is not good for you hurts, right? We've all been there. We all know this in some capacity. But it's not a punishment or even a bad thing, right? That discomfort associated with walking away is a fee that will enable you to live a more aligned life in the very near future. Or let's say you're building something meaningful, something you care deeply about, but it's just you and the idea. There is no validation, certainly no external reward, not yet, and continuing forward in those moments is hard. It's taxing, emotionally draining even. But this feeling, again, isn't a punishment. It's not a fine. It's the fee. It's the cost of admission to bring something into life that wasn't there. Life's greatest moments are expensive. It's just, are you going to pay the fee to bring it about, or the cost of regret at a different time? And you get the point, right? You can take this and apply it to so many things. Falling down, criticism, feeling lost, having to start from the bottom. These things are not fines, they are fees. They are price tags. And so often, the initial price is a bargain compared to what we'll get back. We just need to stop perceiving their mere existence as the world working against us. No, these are opportunities in disguise. It's easy to walk by the important things, to dismiss the uncomfortable things. The harsh truth is that our greatest opportunities are often intertwined in our distress. That's why so many people walk away from the things that will make their lives better. That's why so many people pull their money from the market when it takes a dive. So many people walk away from a project or idea when things get challenging. Or conversely, it's why so many people do nothing at all. They stay in situations they aren't happy with and know they need to change because the fee to get from point A to point B feels too steep. But I think the value is in comparing the discomfort, the cost, the fee to what it's going to bring you down the road, because often it's a bargain. We need to remember that what it will ultimately provide has life-changing potential. Understand that resistance is not a fine. It is not the world telling you no. It's life asking you, hey, do you really want this? Because if you do, it's yours, so long as you sign the dotted line and pay the price. Most people will be dissuaded by this. Most people will turn and walk away, but most people also leave a hell of a lot on the table. And I don't want that for you. You don't want that for you. The world we live in is one of abundance. So when life pushes back, understand that it's merely positioning you to move beyond your limits, to redefine your worldview. And while admission isn't free, it's well worth the price. There's a saying that will always be true. It will be true on your best days and your worst. It will be true after victory, and it will be true after defeat. It will be true when you have momentum, and it'll be true when you're down on your luck, doing everything in your power to create momentum. That saying is, your future begins now. Hey, on the surface, might not seem like much. Sure, my future starts now. I know that. Everyone knows that. Well, if that's true, if everyone does in fact know that, why do we spend so much time stuck, reliving our past, unable to break free? Why do we remain terrified to change? Why do we feel such a connection to who we were, how others saw us? Why must we remain loyal to the character we've been playing in our mental autobiographies? See, here's the thing about the past and the future. One is fixed, can't be changed, and the other, well, it's waiting for you to tell it what it is. One is expired time, one is plans to be determined. And it's interesting how we continue to conflate the two. Epictetus has said that the more things we value outside of our control, the less control we have. Well, I'm going to be the messenger here, relaying the precious truth that yesterday is in fact out of our control. What can be controlled is where we go from here, the next step. Meaning today is not your failures, it's where you take those lessons. It's not your mistakes, but it's what the stronger you can now endure because of them. It's not the dreams you let slip away, but where your pursuit might take you now. And yeah, yesterday certainly contributes to your outlook, as all information does. Its value considered, its impact assessed. It guides you, but it's not you. And that difference is astronomical. There's a question about the role the past plays in our lives. That has to mean something, right? Your past is, in many ways, your story. It's why you think the way you do. It's contributed to your understanding of the world. It will always be a part of you, and I believe that. But I also believe the past is a story. And just like reading one chapter in a book simply sets the stage for the next one without controlling its direction, so does every day that has led you up to now. Life gives us the tools to experience, to grow, learn, and then shed that which does not coincide with what's important. Your failures are not you, but they are precious in that they push you towards what you'd like to be. See, you can experience something and not be that thing. As Kierkegaard says, if you label me, you negate me. If you proclaim me to be X, you're essentially stealing from me the infinite possibility that is the future. Yesterday has nothing to do with what I can become. And so taking it a step further, never mind being labeled by someone else. How could you label yourself and see it as anything but self-sabotage? See, you're never defined by your past, but always learning from it. It's not who you are, it's the cheat codes for what you can be. Without that winding road of misfortune and mistakes, the incredible expansion we long for doesn't materialize. Imagine if everyone who ever felt down in life, felt like a loser, who temporarily lost hope. Imagine if they looked in the mirror and said, okay, this is who I am now. There would be no triumph in the world. Because anything meaningful requires the resiliency to map our way from the hell that was our darkest moments to what will become our proudest moments. Destiny means that you separate the finite from the infinite. What you used to call yourself has prepared you to move towards the horizon. But what you used to call yourself is also as irrelevant now as those seconds that you watched tick away. Seconds that maybe you're not proud of. Seconds that perhaps taught you about the world. Seconds that gave you a glimpse of what's possible, unveiled the happiest of times, all of it. In its own unique way, it brought value, but none of it is your future. Why? Because back to that beautiful, all-powerful sentence, your future begins now. Your destiny is awaiting its marching orders, and all you have to decide as you stand today is where that ship will sail.
Hello, and how you all doing? Morning, Alex and everyone else. You are co-host, Alex, in terms of the process. So let's get everyone in the room. Day 2. I hope you're ready to strap yourself in. Today is a big day. There's a lot of really important information that we will be sharing today. So I hope that you're ready for a really, really important day, because today we're going to be going through how to find the right countries, how to find the right currencies, and how to choose the top 50 in assets in terms of that process. So welcome to all of you. Wonderful to have you all here. How's your brains doing after yesterday? How are you all feeling? I know some people in the group were saying, hey, some of it's a little bit overwhelming. Let me stop sharing here so you can see me better. Some of them were like, hey, it's a little bit overwhelming. There's a lot going on, et cetera, et cetera, et cetera. And I just remind you that I warned you that I would take you on a journey where I would make you, because you were unconsciously, you didn't even know what you didn't know. And now you're starting to realize, okay, hang on, there's a whole nother world out there. And I'm starting to realize, like, I'm becoming consciously unconscious in terms of that process. And what we're going to do today is we're going to go deeper. There's going to be more stuff. Just to be clear, we had a conversation a couple of years ago, actually close to a decade ago now. And we said, listen, do we dumb this stuff down? Like, do we, not talk about IRR and cash on cash and whatever, and just use really simple terms? Or do we actually lift people up to what they need to know? What are the top 1% doing? What is the language of investment? And we decided, what is the point of dumbing it down and effectively making people, because what that would mean is that you wouldn't be able to participate in the real market. And so we decided, no, our challenge is to empower people and grow you and inspire you to play at the level. Like, we can't change the world. We can't change the way the financial industry works. So all we can do is empower you to play in the space. Is that fair? Yes or no? So I can see someone's still asleep. Excited to be here. Felt easier than the first challenge, getting to understand. Okay, perfect. Cool. Well, then I think we should rock and roll, because we've got a lot to go through today in terms of this process. So let me get onto it. Advanced video share. So what do I want? Which video do I want today? Give me 2 seconds. Nope. Where has my video gone? This is very frustrating. Okay, I'm just going to play it directly here.
Real estate. It's one of the most reliable and profitable investments in the world. 49% of the world's wealth is held in real estate. It's what built the wealth of kings and aristocrats. But investing in real estate, for the average person, is simply out of reach. It's a playground normally reserved for millionaires or billionaires. Only the top 0.1% of people own and invest in commercial real estate. There's a wealth gap across the globe that's pricing out the middle class from investing in one of the best ways to build and preserve wealth, which will enable them to give them.
Hang on, is the sound coming through correctly? Richard's saying it's a bit muffled.
Yeah, Scott, we can hear the video clearly.
You can hear clearly?
Yeah, we can.
Okay, cool.
For children a better future. Studies prove that children who grow up in households who have stable financial futures do better in life. That's a fact. But too many people don't have access to it. We want to change that. Let's open up the opportunity to people who work hard, manage their finances wisely, and need a place to invest for their family's future. What we're doing at Wealth Migrate is exactly that. It's simple, but incredibly powerful. We're eliminating the typical barriers to entry when investing in real estate, whether that's knowledge, money, experience, or access. Access to what the top investors know and are able to invest in, but that you can't. We're giving people the opportunity to invest globally in commercial real estate through the internet, right alongside high-profile investors, and earn the same returns and monthly dividends. We're using the internet and our technology to give everyone access to real estate investment opportunities you've never had access to before. By giving you access to global real estate investing, our goal is to empower 1 billion people and close the wealth gap that currently exists. You don't need to invest huge amounts of money to become a part owner of a project. It levels the playing field and helps developers start new projects. It's a win-win for everyone. And then there's our technology, our secret sauce that helps you make smart investments. Now it's your time to grab this opportunity. Do it now with our trusted, secure real estate investment platform. Visit www.wealthmigrate.com to see what amazing opportunities are available right now.
Cool. So I hope you enjoyed that. A little bit of fun in terms of the video. So let's pivot into day two. It's all about types of investments, our asset classes, and our risk. And basically, it's about balancing risk and return goals. So what are we going to be looking at? Well, we're going to be looking at the different types of asset classes. We're going to be looking at risk and return. We're going to be helping you identify your own risk tolerance. And we're going to show you how Mitigate can actually help with regards to that in terms of where we're at. Alex, sorry, do you want to just talk to me? What are you saying?
Yeah, Scott, no, I think that your microphone sensitivity is just a bit too much. So just turn the sensitivity down, because you're getting distorted as you speak a little bit louder sometimes. So that might be the only audio difference.
Okay. Is that better?
Yeah, that's much better.
Okay, perfect. Zoom's become so clever and so complicated. It used to, you just start a Zoom and speak, and now you've got to have a degree in electrical engineering to run a Zoom meeting. Okay, just a couple of tips. And I'm going to go through this every day just to remind you. You've given up this time, you've committed this time to yourself. So I'd highly recommend to pay full attention. You know, try not to be doing emailing, WhatsApp, Facebooking, Twittering. I know that's what I do. I go on these challenges and I sit there and I'm doing other things, and then I'm like, oh, wow, I missed the whole point of that session. And then it's like, well, why was I there in the first place? Take notes, try to teach other people, use the community, play full on, do the exercises, commit to action for 5 days. You know, there's the action. So just, you know, make sure that you're trying to do the homework every day. It's only 15 to 20 minutes in terms of your commitment and doing what you say, you know, setting your goals, taking action and having fun. So just a couple of things that I would highly recommend to help you get results. Remember that we're all about results. I often joke that on my tombstone, one day I want, you know, Scott Picken and then results. And you know, we can come here, we can have all the theory. If we don't help you get the results, then it's just literally a waste of time in terms of the overall process. I remind you also of the resources. So you can go back to the resources, and Alex, maybe if you can just put them again in the link there for people, because you should have all day one's resources. And now we'll go on to day two in terms of the resources, etc. You can join the group, the university group. And again, if you go here and you click on it, so I mean, here's all your resources. So you've got your day one resources. Now you're going on to your day two resources. So if you click on your day one, everything is here. All your resources are here. And if you go to day two now, all of your day two stuff will also be here in terms of it. And if you go to the community, you can literally click on the community here, and you can go through it, and you can, you know, join the community, engage in the community, and participate with other like-minded people. If you haven't joined the WhatsApp group, you can literally go to the WhatsApp group. We just keep you updated when we're going live, all of that type of stuff. Now, I'm a big believer in focus. So our focus here, and why you're here, is about globally diversified passive income and portfolio growth. That's the focus. That's why we're here. How are we going to do that? Well, we diversify across countries, currencies, assets, partners, and time, and it's all about passive income. And then what are we going to do? Well, whenever you got a big goal in life, you should break it down. So this is your long-term goal, and then you break it down into sub-goals. You know, at our mastermind level, we do this on a monthly basis, and then you got your daily tasks and activities. Literally, everything is on one page. So Denise, you're saying there's no sound. I think that's on your side, because there's lots of other people that are all saying it's all good. So all on one page, you can see everything here. You can see here's your focus, globally diversified passive income and portfolio growth. This is your how, and this is your what, okay, in terms of breaking it down and making it easy for you. So that's really it. And then this is the slide that I wanted to remind you, and I can't remember the name, but specifically the person on the WhatsApp group that said that was a little bit, you know, too much for them yesterday, etc. And I'll just remind you, if you're learning to ride a bike, you're kind of going to go through this process of, you know, understanding basically in simple terms. So yeah, Christelle says she loves this slide. I do too. I've seen it from Dr. Anastraya. I've seen it from Tony Robbins. I've seen it from a number of different people. But the point being is that, you know, we're going on this journey, and I'm consciously taking you on this journey. And so if by some chance you're feeling overwhelmed, don't worry about it. Just hold on. And, you know, we're going to be able to get you to the outcome in terms of where you're at. So day one was all about understanding diversification. If you remember, I went through the from Tony Robbins, you had the dabbler, the stressor, and the master. Now, the dabblers, chances are they're not even here. They tend to only come for day one, maybe day two tops. The stressors, they're still here, they're stressing, they're trying to figure it all out, they're trying to figure out how to do it all themselves. They're trying to probably screenshot all my slides and go, maybe one day I can figure out how to do this all myself. I know, because that's me, remember. And then the masters are people that are going, okay, they got more peace of mind. They're kind of going, okay, cool, I want to learn this stuff, I want to be empowered, but actually I can model others, I can copy others, I can even partner with people. So it's a far more peaceful way of doing it, a lot less stressful in terms of the overall process. And Christelle says, lots of love, that's me. I know, Christelle. I remember, if someone was a stressor, then I know exactly what it's like, so I know exactly what you're going through in terms of that process. I remind you of the action steps from yesterday. It was identify the list and risks that are associated with not diversifying. So what are the risks to you not diversifying? Secondly, write down what's stopping you from diversifying. Thirdly, fill in on your sheet. So the very first page, the very first block here is the 5 whys. Why is diversifying important for you? I mean, hopefully yesterday I gave you a whole bunch of reasons, but why is it important for you? And then share one key takeaway with the Wealth University group, and actually go and look at where you're at. And I don't know how to pronounce your name, but MySec, buy an index fund with global exposure. It's one of the ways. I mean, that's one asset class. So we're going to go through that. That's 1 of 15 in terms of what you're looking at. Okay, the second action, the gold, and you didn't have to do this last night, but I would recommend you do this at some point. Create a list of your assets and investments you currently hold, if any, and identify if there's any concentrational risk. You'd be surprised how often people join our mastermind and they sit down with our family office and they do what's called a health check. So it's like when you go to the doctor and the doctor does a health check on you and they look at your portfolio, and you'll be surprised how often there's an overlap, there's wasted fees, there's wasted exposure. They think they've got diversification, but they actually don't, because there's a whole bunch of concentration and overlap and effectively wastage and risk. And that's why we do the portfolio health check. And then in step 5, we do asset allocation, which is all about portfolio optimization and making sure that your assets are not only protected, but are also getting a far better return, because at the end of the day, you want your assets to be safe, but you also want them to work as hard as possible for you. I don't think there's too many people that are on here that wouldn't want their assets to be safe and to be working hard for them. Just tell me if you agree with me, because that's exactly what we do for our mastermind members. The next steps navigator is there if you would like to go and fill that in. And I do remind you that, Alex, would you do me a favor, mate? When I put up all these slides, would you just put in the links each time so that people have them if they want to click on them, basically. I do remind you that today, neither myself nor Alex nor the team are going to be giving you financial advice, but we are sharing with you our lessons, our mistakes, what we've learned. I've done this now. This is my 29th year of doing it. So having helped people in 178 countries, I've made a lot of mistakes. And I want to share with you the lessons I've learned and also the patterns that I've learned and seen of what works, specifically the benefit of the last 10 years of working with our family office. By the way, you're going to meet our family office tomorrow. And it's just amazing the level of advice, the level of knowledge, the level of partners, access to partners that the top 1% get that the rest of us just don't get access to. I remind you also of our homework competition. And so every day you post your homework into the community group, and there are awesome prizes. And oh, sure. Start the year with a cold. That's a good way to kick off the year. And the first prize is going to be a VIP upgrade. And we went through and we looked, and the person that is going to be the winner for the homework is Lefa. So, Lefa, I would like to congratulate you. Thank you for all the blessings. Lefa, I'd like to congratulate you. Well done. Congratulations to you. You have been uploaded or upgraded to the VIP. So the team will, Alex will send you the link on how to join the WhatsApp group, and you can join us for the rest of the VIP sessions, and you'll get access to all the benefits of being in the VIP. So congratulations to Lefa. I hope I'm pronouncing your name right. Lefa, I'm not 100% sure, but congratulations to you in terms of doing your homework. And then just to remind you that there will be prizes for the most engaged and homework, etc. We love giving away prizes. And the whole idea for us is to create engagement. And we do incentivize, call it ethical bribery. We incentivize people to take action because it's the action takers that are going to get the results. And then for those of you that still want to join the VIP upgrade, I know that we did our first VIP session yesterday. And I don't know if people want to type in the chat box what their thinking was, but I just screenshotted a few of them from yesterday in terms of what people said. Really enjoyed the session. Thanks so much. Fantastic session. Great course. Thanks from Portugal, et cetera, et cetera. So Shona said she loved the VIP. So yeah, there's still time. If you haven't joined the VIP, come and join us. Maybe, Alex, if you could just put in the link to the VIP, I'd appreciate it. Oh, there, you've already done it. So Alex already put the link into the VIP. So yeah, come and join us in the VIP. It's one thing getting the theory, but it's another thing when you actually get to engage and ask questions and go through everything. It's from my experience, it's the people that join the VIP that get the most results. I don't know why. I think it's as simple as when people pay, they pay attention. So thanks for love the VIP, very insightful VIP session. And yeah, the cool thing is we got 4 more. So another one today, tomorrow, Thursday, and Friday. And you get access to all the recordings. So yeah, anyway, Lefa will be joining us. And if anyone else wants to, you can still just go to that link, pay the $47, and it's worth over $8,000. So you're getting a hell of a lot of information. So today, I'm going to share something with you, which I know will sound too good to be true. But we sat down as a team in October last year, and we said, how could we help someone get a passive income in under 30 days or less? And we set out to set ourselves a challenge. We used to try and do it within 12 months. And then we said to ourselves, how can we do it within 30 days? And we did a pilot project at the end of last year. Alex, my partner, actually ran that project. And we successfully got people to achieve passive income from just starting, like have never done it before, to investing and earning a passive income in 30 days. So if that sounds too good to be true, then so be it. But I will share it with you. Alex, we'll go through it in a lot more detail later, but it's a bit of a tease. I don't know if you just want to plant a seed and tease people as to why they should wait around and listen.
Yeah, Scott. Hi, everyone. Lovely to share a screen with everyone again. A tease. I would say a lot of people always talk about getting results, and last year we actually got people results. So it wasn't just theory. It wasn't just saying that you were going to do something. We actually did it, and people got money into their wallets within literally 4 weeks. So yeah, if that's of interest, stay tuned.
Awesome. No, thanks, Alex. So yeah, it's a little bit of a teaser as to what we're going to be talking about later, because our whole philosophy is, results and action. So if you haven't picked that up already in terms of everything that we talk about. So this is my interest. Was anyone here on that 30-day challenge? I'm interested to see if anyone did it. Richard said the 30-day challenge worked. So that's brilliant. So that's fantastic, Richard. I'm glad that you enjoyed it. I can see that Christelle said she was. Maureen, I got results. I can confirm. Carol, yes. Lisa, yes. Anastasia, yes, I did it. Oh, cool. How cool is that? Alex, you should you should take a screenshot there, dude, of everyone that got success with you. Well done. Awesome. And so to those of you who are sitting here saying it sounds too good to be true, I'm sure there's lots of you. You can see people have literally put it in the chat box. In terms of that process. Okay, let's rock and roll. So yesterday I introduced you to Jordan. He was a 55-year-old and he'd worked hard all his life and he wanted to preserve his wealth. You know, he wanted a passive income of $5,000, $10,000, $25,000 simply and safely. He wanted to diversify across countries, currencies, and assets. He wanted to get effective results with predictability. He wanted to save decades of frustration and millions of dollars to get the right knowledge for him and his family. He wanted wealth protection, a plan B, and peace of mind. He wanted to be held accountable to be able to get results. He wanted a family office to help him with all his financial affairs. He wanted generational wealth for his family. He wanted a fully completed, executed wealth plan. He wanted to get results. So, again, I remind you, if these are the things you want, then you're in the right place. Victoria was a 50-year-old devoted to her family and aiming to build generational wealth. She had a very packed schedule. Time was a major issue to her. So she's needed a streamlined investment strategy. She wanted to be empowered to make wise decisions that aligned with her goals to free up her time for her grandchildren and children. She wanted to understand the investment landscape. She wanted to feel empowered. She was tired of not trusting the financial industry so that she could make the right decisions for herself and her family. And Victoria is focusing on financial freedom, you know, so that she can enjoy the moments with her family. Again, if this resonates for you, then you're in the right place. And ideally, if both resonate for you, then, you know, you're even more in the right place in terms of that process. So this is the formula. You need to diversify across countries, currencies, assets, partners, and time. Now, this is a fun little game that I like to play. So if you were playing Monopoly, Global Monopoly, and someone came along to you and they said, hey, Joe Soap, which country should you invest in? And people are like, I don't know, come on, maybe let's play the game quickly. So type in the chat box, if you could pick one country to invest in the world, where's the best place to invest? Just type the country. So we got the UK, we got India, we got the US, we got Brazil, America, UK, USA, US, India, Dubai, US, UK, Germany, China, Dubai, UK, Dubai, New Zealand, Malaysia, Argentina, Dubai, India, London, India. Sure. Interesting. So it's fascinating when people put it out there. And so I always say to people, my next question would be, okay, cool. Everyone's put out their different countries. And then my question would be, why? I got someone here, Johannesburg, Portugal, Spain. So very interesting for me as to where people put it. So for me, basically, it happened many, many years ago where I'd been watching Clem Santa. He's one of the top 5 scenario planners in the world. And I went away because I'd watch his scenario planning every time. And I'd go, what's the point of hearing these scenarios on where the global economy was going without actually coming up with a way to invest? And so I ended up building a 4-dimensional model, and I shared it with Clem Santa, and I was actually really embarrassed. It's quite a funny story. I built the model. I sat on it for about a year, and then eventually after about a year, I was like, maybe I should share it with Clem. So I shared it with him, and I met him on the Tuesday, and then we were presenting together on the Tuesday and the Thursday. And then on Thursday, I heard him talking to someone else, and he was like, hey, where's that young man? I want to talk to him about his model. And I was like, again, a bit embarrassed. Anyway, long story short, he actually said it's a really good model and you should write a book. So in 2013, this book came out, Property Going Global, forwarded by Clem Santa. It was endorsed by him in terms of the process. And that's really where this all started in terms of creating the modeling to be able to make the right decision. So if you look here, I don't have time today to go into this, but ultimately you want to be able to go into looking at your countries, currencies, assets, partners, and time. And it'll be different for residential property to commercial property to alternative assets. So you want to be able to do it for all 3 of them. But for today's purposes, and to just give you an idea of how this works, I'm going to do it for residential property and I'm going to show you how you can choose between the top 5 countries, currencies, and how to find the top 15 assets. So we're going to go fast. There's a lot of information to share. And 10 years later, Shane came to me, my business partner, and he said to me, listen, we need to write another book. We need to upgrade your book. And I said, dude, I'm never writing another book. I'd rather run Comrades back to back. And and he said, okay, cool. Well, why don't we create a digital course? So we created the upgrade of this, the 10-year upgrade, the digital upgrade, and it's called Wealth Going Global. And there's a bunch of modules. And the first module is about the countries. So it's uncovering the global market, where to invest. And the mission of this module is to help investors get 100% clarity on the countries they wish to invest in and avoid, oops, sorry, I'm not sharing my screen here. Let me just go back one slide. So module 1 is the countries, uncovering the global market, where to invest. And the mission is to help investors get 100% clarity on the countries they wish to invest in and avoid the mistakes that more than 80% of investors make. Now, Clem Sunter has the scenario planning model. And like I told you already, I sat down and I was like, because he updates, I don't have time today to go into it, but he's got different scenarios, he's got different flags, and he's got different probabilities. And then depending on what's happening in the world, it helps you make better decisions. So I took that and I created a 4-dimensional model. Now, you basically got risk. So you can see here risk, and there's pillars. There's fundamental pillars to investing, and they are based on risk. And then on the right-hand side, you got return. Now, if you look here, under risk, you got economic risk, you got the value of the property, you got population growth, you got supply and demand, you got rule of law. And if you take that on a balanced weighting, it gives you a risk index. And on the right-hand side, you got a return, and there's a balance between yield, which is income, and capital growth. And then it gives you a return. Now, you'll notice that I've got a 70-30 weighting. So again, you can play with this model if you want it, but I believe that income is more important than capital growth. Now, middle class and professional people are always chasing capital growth. Hey, look, I bought my house in Cape Town and it's doubled in value. Hey, look, I bought Bitcoin and it's doubled in value. Hey, look, I bought a share on the stock market and it's doubled in value. That's how middle class investors think, because they chase capital growth, whereas wealthy investors chase income. And that's why it's got a higher weighting for income. And so what this does is it ultimately gives you a framework where you can see on the left here, you got return, you got low return and high return. And at the bottom, you got risk, and you got low risk and high risk. So ideally, you want to be in this yellow quadrant of, which country is the right country to invest. Now, by the way, these are the graphs that I used in my book. So I've done it on purpose, that just so that they assimilate with the book. Now, people say to me, okay, Scott, but that's all wonderful. Where do I go and find the right information? Like, where do I actually go and get the information? So who would like me to just share with you where to get the latest information? Because the point with models is the models are built, but you got to know where to get the right information. And Richard, you're in the process of writing a book. Good luck, dude. It's extremely difficult. Well, it certainly was for me. So, okay, so let's go here quickly. I'm going to show you some tools that I like to use. So The Economist is probably the one that I like the most for residential housing. It's the most interactive guide that I've found. And what I like about it is you can go in and it's got all the different countries right the way back to 1970, as long as they had data back to 1970. So let's choose 2 countries. So if I go back to all those countries, we had the USA, the UK, Dubai were probably the 3 that came up the most. India came up quite a few times. Yeah. So okay. So I'm going to just for the purpose of this, I'm going to use the USA and England. So you can basically see here. So you can see in this graph here that England is in the light blue and America is in the dark blue. So you can see here that since the year 2000, American property prices are 50% up, whereas British property prices are 94% up. Okay. Now that's in real prices. Okay. So what that means is taking into account inflation. If you go nominal, then the UK, America's up 129% and Britain's up 190%. Okay, you with me so far? But what becomes more important and what investors don't look at is you should take into account income. So this takes into account affordability, like how much money does the local British person make, or how much money does the local American make, and how affordable are the houses? Because the more affordable a house, if people are earning enough money, the more affordable a house, the more the property price can grow. Whereas if houses are already very unaffordable, like they are in England or Australia or Singapore or Hong Kong, then the chances of property prices being able to grow much more are constrained. So if you look at this, based on income, in the United States, properties are 6% overvalued, but in England, they're 28% overvalued. And then the last one, and in my opinion, the most important one, is you go to rent, which is basically the income that you can earn from the property. And in this case, you can see that in the United States, house prices are 15% overvalued, whereas in England, they are 39% overvalued. Now, just as my interest, someone was saying Dubai. Let's see if they've got Dubai. I don't know if they do. Probably no, they don't have Dubai. That's a pity. They've got South Africa, but not Dubai. That's fascinating. Now, let's just use South Africa as an example because there's a bunch of people. So you can see here, like if you look at South Africa, like look at the massive growth of South Africa in the year 2000. Look at that for a place to make money in the 2000s. But anyway, I think you get the point in terms of the breakdown. Now, if you want to go into more detail, you can go in and you can look at the global city index. You can actually go in and literally get more specific with regards to cities. If you want to go to each country, so in America, the best one is the S&P Core Logic, where you can literally go and get all the different information around the American property market. In England, it's Academimetrics, which is where you can go and get all the information around the UK property market. And then in Australia, it's Core Logic. So again, you can go and get all the data here, news and research in terms of Australia. And then in South Africa, as an example, you've got the F&B Property Monitor. So you can go and pull all of this information in terms of what is happening around the world. Now, I just wanted to show you something quickly. And where's it gone? Here we are. So if I go to Wealth Hackers, and I literally just go into the classroom here, and I go to Wealth Going Global, and I go down to uncovering the markets. So this is the countries here. So it's the one that we've just done. You can literally see the different breakdowns. So when you do Wealth Going Global, the course, you get access to everything. So you can see the breakdown of all the different graphs. You can see Clem Santa. You can see where all the research comes from on the countries, the different so all the different countries, population growth, rule of law, everything. So all the links are here. And that all assimilates back to this global property system. So I don't normally give away my calculators, but I have done here. So this is the latest update. So I'm just giving you the latest update here. So you can actually see that the majority of the countries in the residential space are actually sitting below in the low return, low risk. South Africa is the only one in the high return, high risk. So that's in residential property. In commercial property, it's different. You've got the US and India are sitting in the high return, low risk. And the rest are kind of sitting around here. And then the alternative asset space, you've got United States and United Kingdom. So I'm giving you a little bit of a snapshot into how this all works. Again, today, I mean, when I do the Wealth Going Global, we actually run it. It's 6 modules over 6 weeks, and I go into this in a huge amount more detail as I showed you here. It's all here. All the different systems are here. All the research is here in terms of being able to get access to it. But for the purposes of the challenge, I just wanted to show you the depth behind it. And then we went and we built out. So the next evolution was GIDS, which was our global investment due diligence system. And that basically is a 10-layered system. So it starts off with currency, then it goes into macro, all the macro stuff I just showed you. Then it goes into financial optimization. So that's about setting up tax and structuring and everything else. Then it's about finding the right partners on the ground. Then it's about analyzing different cities. Then it's actually about looking at the actual investment, let's call it a property investment, doing the due diligence, maximizing the investment, making sure that the money is getting back into your wallets and that you're getting the best customer experience. So there's 10 different levels. So just in my interest, I know that it's a lot of information, and I also I'm excited to share with you that Shane will share with you some of the links in terms of just some of the stuff that I've already shown you. You do have to pay for The Economist, but anyway, I just wanted to show you, because why this is important to me is when I said to you which countries, and people just chuck out different countries, it's fine, and it's based on your opinion, your gut feel, your sentiment. But the question I have is, do you have systems like I've just shown you with all the data, specifically things like this, to actually help you analyze which countries to invest in, where to invest, why to invest, and then literally breaking down the countries as to like which are the top countries to invest in for alternative assets, which are the top ones for commercial assets, and which are the top ones for residential. Just my interest, do you have systems like this? And if you don't, there's no problem. But you've got two options. You must either go and create systems, or you must partner with people who do have systems. Does that make sense? And to Benson, he said, what makes the US so prime for investment? Sure, Benson, I could talk about that for a long time. Let's go back to so I don't know if you're talking in residential, in commercial, or in alternative assets, but hopefully I've already shown you in residential it's not at the moment, but in commercial property it is. There's the US there, and in alternative assets it also is. There it is there. And one of the key things that I think is important is a couple of things. Well, there's a lot of things basically. So America is a massive place. It's got 300 metropolitan statistical areas, which are a fancy word for cities. So it's got 300 different cities. If you invest in Australia, there's like 6 or 7 cities. If you invest in England, there's like maybe 8 cities. And so one company or person can dominate the whole place. Whereas in America, it's too big. It's so much diversity within America. It's so economically resilient. It's the powerhouse, et cetera, et cetera. And so the thing with America is you can't say you're going to just go invest in America. I could talk to you. I could literally spend the rest of today just on America. I started investing in America in 2011. I started trying to invest. I told you this yesterday in 2010. And we've invested hundreds of millions of dollars into America. So I've got a huge amount of experience around what works and what doesn't work. And Alex is saying to me, I need to say it's because of Donald Trump. It's not because of Donald Trump. It's not because of Biden. It's not because of Obama or any other president. They come and go. The economic fundamentals are what is important. Although I do think, and I'm not getting into political debate, but I do think that America is going to see quite a growth spurt over the next couple of years in terms of where the world is going, and particularly in terms of their economic development and things like America First and et cetera, et cetera. So I don't know, Benson, I don't want to take too much time here. And I think what I'll do is I'm going to make that, if you can remind me, Alex, that can be a topic for the VIPs later, because otherwise we'll run out of time today. But it's certainly a place that I would strongly recommend. I'm not giving you advice, but I would strongly recommend that a portion of your portfolio is in America, but definitely not all your money in America. Okay, module 2, currencies. So just remember, before I go to module 2, remember under your countries, you've got your top 5 countries. Now we go to module 2, which is about currencies. And you've got the currency conundrum, managing risk in global investment. This will help investors diversify their portfolio and mitigate risk by investing in multiple currencies. Now, again, in my book, I said, well, everyone's guessing, and most people have heard of CPI, which is the Consumer Price Index, which is where in most countries around the world, they go and they take a basket of goods. So I created the Global Wealth Index. I was like, well, why don't we look at currencies as a basket of goods? So I created the Global Wealth Index, and what it basically was a basket of goods. So it determines your ability to be a global citizen, your ability to be able to invest around the world. So it's got a family holiday to Disney. It's got a skiing holiday to France. It's got a private school in Australia. It's got a Harvard education for a child of yours. It's got immigration to Australia or America if you want. And if you put it all together, it gives you your buying power in different currencies. So you can do it in any currency. I've done it in multiple currencies, but specifically I did it for South Africans as an example, where I did it in 1983, 1993, 2003, 2013, and 2023. And South Africans have lost 92% of their buying power over the last 40 years. 92%. Now, you can do this in Singapore dollars, you can do this in pounds, you can do it in euros, you can do it whatever you like. But what basically it helps you do is start to look as a global citizen between investing in different markets. Now, my whole philosophy in life is to partner. So I never try and learn everything about everything. It's impossible. So I go out and I try and find someone to partner with. So chapter 2 of this book is written by a guy called James Painter. James is an amazing guy. I've worked with him now for probably 15 years. And the best way to describe how he looks at it is like the weatherman looks at weather patterns. And so he wrote chapter 2 of the book. He also did module 2 of Wealth Going Global, all around the currencies and what are the hidden engines in the markets and why do exchange rates adjust. So this is really important. And again, if you want to go and do the Wealth Going Global course, it's all here, where he literally takes you through all of this. What do you need to know? Why do you need to know it? And then you've got my Global Wealth Index calculator, which I've already shown you, which actually sits here. Now, what's important is that James gives us the research. So I don't have to go and do the work. So if I'm looking at, there's multiple different currencies here, the US dollar to Rand, the euro to Rand, the pound to Rand, but he's got all of them. He's got the pound to dollar, the euro to dollar, he's got Bitcoin, he's got everything. But what this allows you to do is to go and look at graphs, whether they're short daily graphs, medium weekly graphs, couple of monthly graphs or yearly graphs. And again, when we go through the course in Wealth Going Global, it teaches you, what you need to know. But the whole idea is you don't have to go into all this detail. Like you've got two choices. And that's why I started yesterday. You've got the choice where you have to go and learn all this stuff yourself. You have to figure it all out yourself. Okay. Or you can partner with people. Now, I still think it's worthwhile having a base level understanding, like just so you feel empowered. But the bottom line is I'm trying to show you all the stuff that if you're not doing this, it's a problem. If your financial advisor or someone that's helping you with your money is not doing this, it's a problem. Someone needs to be doing this to be able to help you make the right decisions. And so when you do this, it then helps you come up with what are your top 5 currencies that you should be investing in. And ultimately that allows you to determine the top currencies. So as an example, the euro is increasing in value against the dollar. It's expected, according to James, to increase anywhere from 25 to 40%. So like you should, and again, I'm not giving you advice, I'm just telling you my own personal learnings. You should have exposure in the euro and not have everything in dollars. The pound has always been a very stable, currency. So you should have exposure in pound. I'm just giving you an example. Bitcoin is certainly the future of the crypto space. So if I look at my top 5, and I can literally go in, if you want to go and look at my top 5, give me 2 seconds. I'm just logging in. Okay. I'll show you what's going on there. But the bottom line is this helps you come up with your top 5 currencies. And then the final module for today is your top 15 assets. Now, this one is more detailed. And again, when I sit with people, and I know someone above said that we should be investing in an index fund, that for me, what's interesting is that I and Ray Dalio yesterday said you need 15 quality assets. Well, which ones? Building your global portfolio, selecting the right assets for investment. So we help investors understand the top 15 assets they would like to invest in without losing money and spending decades researching them through trial and error. So, when you sit down with your piece of paper, were you able to come up with 15 assets, the top 15 assets? Would you like me to share with you what I think they should be? Is it just me? Have I lost all you guys? Are you gone? Debbie said no, could not think of 15. Yeah, I think that's the point, Debbie, is that a lot of people, it's quite overwhelming in terms of even just trying to think of it. So let's look at the asset classes. So these are the top 15 most commonly recognized asset classes according to ChatGPT. So you got stocks and equities. So that's basically owning companies on the stock market. You got bonds, which are debt and securities. So that's basically where you lend money to governments, municipalities, and corporations. You got real estate, which is property. So you got residential, commercial, and industrial. You got cash, it's where you put cash in the bank. You've got commodities, which are raw materials like gold, silver, oil, gas, wheat, etc. You got mutual funds, which are pooled funds. So where multiple investors come together and invest in multiple different things. So this is very much a spray and pray approach. You got exchange traded funds, which are similar to mutual funds, but traded on stock exchanges like individual stocks. So this is we're going to learn more about ETFs from Ann Wilson. She's amazing in terms of this space. You got derivatives, which are financial contracts derived from an underlying asset, such as options, futures, and swaps. You got currencies, which is forex, trading one currency against another. You got private equity, which is ownership in private companies. So these are ones that are not listed on the public stock exchanges. You got hedge funds, which are investment vehicles that pool capital from accredited investors to employ in various investment strategies. You got venture capital, which is where you invest in early stage companies that have high growth. You got arts and collectibles, which are artwork, antiques, rare coins, cars, whiskey, whatever. Cryptocurrencies, I think that's fairly self-explanatory with Bitcoin, etc. And then you got infrastructure like transportation, energy, utilities, etc. So those are the 15 most commonly recognized in terms of the process. Now, who knows the difference between the primary and the secondary market? I got a couple of no's, no. Okay, so today I'm gonna touch on this lightly. Again, in Wealth Going Global, I go into this in a lot more detail. But in simple terms, the secondary market is the stock exchange. So you already know about the New York Stock Exchange or the London Stock Exchange or the Sydney Stock Exchange or the Johannesburg Stock Exchange, etc. It's basically the stock market. Okay, so it's where companies are on the stock market and they trade it, and you can buy and sell shares quickly and in terms of the process. They're very liquid. The primary market is assets like this house that are existing assets that are not on the stock market. So if you want to buy this house, you've got to come and buy this house from me. And it's a much slower process to be able to buy this property. Does that make sense? So the primary market is direct ownership, whereas the secondary market is where you own stuff through the stock market. Now, there's a lot of pros and cons to the primary market and the secondary market. And the majority of the financial industry has your money in the secondary market. They've learned how to make money out of you by helping invest your money in the secondary market. More than 50%. So tomorrow, I'm going to show you what the top 1% invest in. I'm going to teach you about asset allocation, and I'm going to show you what the top 1% of, so there's 580,000 of the wealthiest people in the world. What do they invest in? And you're going to be astounded to see that more than 50%, generally as high as 60 or 70%, is actually invested in the primary market. So the wealthiest people are investing in the primary market and you investing in the secondary market. Is there a problem? Is that a problem? So Christelle says yes. Richard says crikey. Shona says yes. Maureen says no. Loretta says wow. Leisha says definitely. Maureen says yes. Look, my philosophy, let's go back to what we learned. There's a logic to how we put this challenge together. We learned it yesterday from Tony Robbins. If you want to be successful, copy a successful person. If you want to be wealthy, copy a wealthy person. If wealthy people are investing in the primary market, then why, through your financial advisor, are you investing in the secondary market? And I can tell you why. It's because they don't know how to make money by helping you invest in the primary market. It's that simple. It's literally that simple. So why no residential? Well, let me explain to you the value chain of real estate. Now, I already explained to you yesterday my own story of doing 2,500 residential properties and realizing how much hassle was involved and how little money I made. So how much hassle was involved and how little money I made. And then when I went and did commercial property, how much money I was making with very little hassle. How much money I was making with very little hassle. I was like, this is a no-brainer. Like, I want lots of money with low hassle compared to residential property that was lots of hassle with no money. And so the value chain of real estate is something that I learned having done this thousands of times around the world. And if you look at the old system, you're over here. Where's my mouse gone? You're over here and you want to invest in this property, okay? And unfortunately, there's 16 different middlemen between you and your property. There's no trust, there's no transparency, and because of the high fees, there's low returns and no alignment. And what's so interesting is that the old system is broken. And even people buying house apartments, you'll be amazed how many people come and see Alex and I and the rest of the team, and they go, listen, I've gone out and I bought a whole bunch of houses, or I bought a whole bunch of apartments, and they just don't work. Like, they're not helping me retire. There's so much hassle. It's even worse if I've got different places in different countries. They cost so much money to run the tax and the structuring, and the bloody tenants keep complaining, and the management agents are useless, and, blah, 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 blah. And I mean, just if I was in a live room, I'd say, put up your hand. But does anyone else agree with me that buy-to-let investing is basically dead? Okay. And why I say that is because 20 years ago, it was the only way that I or you could participate in investing, really. It was a middle-class way of investing because we didn't have technology and we didn't have access to commercial property, but we do now. So, and now when you understand the value chain of real estate, why would you play at the bottom of the value chain of the real estate when you can play higher up the value chain? And I'm going to show you why I think it's dead. And I've always had the ability to be ahead of my time, but mark my words, it's 2025. By 2050, buy-to-let investing, the way we did it in 2000 and have done it for the last 25 years, will be dead. And I know in England, people are saying, Deborah's saying, I mean, it's getting harder and harder in England. There's more laws, more blood, it's more hassle. The government's making it more tricky. There's more taxes, et cetera, et cetera, et cetera. So let's look at the value chain of real estate. Now, again, I could spend 3 hours on this, so I'm going to just give you a high-level flyover. But there's basically 5 main stages. You've got land zoning, which is where you've got a farm. It's greenfield. They get planning permission. They turn it into brownfield, and it enables them to build infrastructure on it. Then you've got a developer. They come along and they build. Might be houses, it might be apartments, it might be office blocks, it might be shopping centers. It doesn't matter. But they build a vertical structure. Then comes along an investor. They buy it off the developer and they put a tenant in it so they get an income for the building. Then the number one way that people make money in property or in real estate is that they sell it to a fund or a REIT, a real estate investment trust. And then at that point, you and I come along through the secondary market, by the way, and we invest in these funds and REITs via our financial planner, and we get access to the property. Now, let's look at the returns. A land developer is looking for an IRR of around 30%. Now, they don't always get it, but this is their target return. A developer is looking for a return of about 25%. And an investor is looking for a return of about 20%. A fund or a REIT is looking for a return of about 5 to 8%. So they are basically buying what is called stabilized income. So they are buying stabilized income. Now, when you go and put your money into a pension, what do you want? What is the one reason that you're putting your money into a pension? Just type in the chat box for me. What is the one reason that you're wanting? So you're saying to grow it, to grow it, to grow it. It's interesting. Most people I know, they got their money in their pensions, they're not growing it. So, but what is the thing that you want from it? So I got nest egg, to have retirement, stable income. Okay, Richard, I think you're the one. Income. Okay, a couple more people are saying income now. I mean, the reason we cash flow income, yeah. So to put food in my mouth, income, yeah. So all the people that are putting income, cash flow, etc. I think that you're all are closer to the truth, which is where you're putting your money into a pension so that one day it can give you income so that you can continue to live. So what a pension or a fund or a REIT does is they buy stabilized assets with stabilized income to give you income. But they pay a premium for it, which is why the property investors make the most money. And then you and I come along and we earn kind of 2 to 6%, and we battle to beat inflation, and we wonder why we're going nowhere, and we wonder why in our 60s, 70s, and 80s we are financially trapped. If you think I'm wrong, go to my LinkedIn profile and go and read an article here, which was in the financial press, about this company called the Billion Group, which was a developer. It built a whole bunch of shopping centers, and then it sold it on to Rebosis. There was a big property fund that then took it to the stock market and sold it to through the stock market, through the secondary market, to all the investors, and how they overpaid for it. And the only person that made the money was the owner of the Billion Group, that was the developer. And the sick thing here was that it was the same person that was the owner of the Billion Group and Rebosis. And this, ladies and gentlemen, I've been doing this for a long time now. Next year I'll be 30 years, 3 decades. And the number one way I've seen that people make money in property is by the investor here selling to a fund or a REIT. So my question is, why do you not go up the value chain? Why don't you just cut out these middlemen, and why don't you go up the value chain and become an investor and start investing in industrial buildings and office parks and multifamily and everything else, and or even become a developer and take a bit more risk? And yeah, give me some reasons. Why don't you do it? If this is so obvious, maybe this is the first time you've ever seen this. I don't know how sophisticated you are, or if you've ever thought about it before. But I mean, even in development or buying houses, developers go and they make all the money. These guys, the developers, make all the money, and they sell the end user houses to you. All the profits off the table. I've yet to see, in England or South Africa, the developer makes all the money, and it's the retail investors that take a decade to make money out of doing it. And I've got here, I don't know how, ignorance, high risk, no knowledge, lack of knowledge, high risk, I need more money, my son is in construction, it's all about capital to start the development, because you don't know how, little knowledge, money. So yeah, I mean, I've done this for a long time, and these are just some of the things that people say. It sounds too good to be true, access to partners, there's too many scams, I don't know how, too much compliance, it's too difficult, I don't have time. What about the structures, management, time and effort, too complicated, how do I protect myself, etc., etc., etc. But the three things that have come through over and over again are, I don't have the money, I don't have the knowledge, and I don't have the time. I don't have the money, I don't have the knowledge, and I don't have the time. Now, it's interesting because you can have $10 million. Literally, you can have $10 million. You can come to me and say, hey, Scott, I'm going to America, and I'm going to go do investments in America. I've got 10 million US dollars. And I'll be like, cool, you can have 100 million. It won't make any difference. Because to come in from the outside where you don't know what you're doing, you don't have networks on the ground, you're going to be eaten alive. So the metaphor I like to use is Uber, because we all know how Uber works. And if you think about it, 15 years ago, you would have arrived at Heathrow Airport and you would have, literally phoned a taxi owner association, who would have phoned a taxi owner, who would have phoned a taxi driver. They would have come to pick you up about 2 hours later. They would have driven you around London, because you didn't know where you were going, and they would have, overcharged you. If you left your cell phone in the car, you'd never see it again. And then Uber came along, and what did it do? It literally cut out the middleman. It cut out the costs. It put me directly in contact with the driver. It dramatically increased the trust and transparency, and it improved the accessibility. I mean, before Uber, how many of you had a private driver? Whereas now, as long as you've got a smartphone, each and every one of us has a private driver. And so that's the metaphor I like to use, because we all understand Uber. And so using technology, you can go up the value chain, and literally, you can be an income investor. You can invest directly alongside institutional partners at the investment level, or you can do the growth side, where you can invest alongside developers at the development level. Don't you think that's pretty cool? And that's why I don't buy houses or apartments. That's what I call mom and pop investing. There's no need anymore to just buy a house or an apartment. Now, don't get me wrong. If I'm going to buy a house or an apartment, I'm going to buy 500 of them. Again, I'm going to think like an institutional investor. I'm not going to think like a mom and pop investor. Mom and pop investing is overcrowded. There's lots of people in the middle class. They're all running around. They're all going on property courses. They all think that they're going to make offers and buy houses, etc. And it's like, why be a mom and pop investor? Why not just go up the value chain and start to think and invest as an institutional investor, as a sophisticated investor, and literally, you don't have to know how to do it all, because you're going to partner with people that are doing it. I see someone said the penny's dropping, and I'm glad it's dropping, because this is important. This is very, very important. If you're wanting to do it all yourself, good luck. It's going to take you the next decade at least. But at least I'm showing you what to do. But if you want to partner, then you can get started this week. Right, what don't we do? Well, we don't do assets where you need to pay an expert. So what I mean by that, if it's super complicated and like I need to pay someone to really understand what the hell's going on, I've found that when people lose money, it's because it's super complicated. So if it's too complicated, like I'm not interested. Like it's just too difficult. Okay, and the chances are that if there's some super clever expert with some super complicated investment vehicle, there's a good chance that when it goes tits up, then like, there was a problem to start off with. So the next one is we try and avoid assets where there's no income. So we like to focus on assets where at least a part of the investment is income. We do investments that are only growth, but then there's specific reasons why we do those ones. But we do tend to try and focus on income producing assets. We try and avoid assets which are short-term, volatile, and high maintenance. So what I mean by that is day trading or cryptocurrency. I mean, I've been on holiday for the last 2.5 weeks. I didn't have to check my phone every 3 minutes to make sure that the crypto had gone up or down, or the stock market had gone up or down. It doesn't matter. Like my property wasn't going anywhere. So I don't like things that go up and down like daily. Assets we don't understand. So I'll give you an example of this. Alex wants me to get into derivatives, and like I've never understood futures and options and swaps, and I just I don't think I'm not the smartest guy in the shed, but I'm not stupid. But derivatives have always been something that just don't really make sense to me, and so I tend to try and avoid things where they just don't make common sense to me. I don't want to do things that mom and pops do. So I don't want to do things that the retail investors are doing and the mom and pops are doing. So, running around trying to find buy-to-let houses in England that every other mom and pop investor, I mean, it's probably the biggest, part-time job or hobby in England is to be a mom and pop retail investor. And what I find fascinating is, and Alex, make a note here because we should record this for Jeff, where what I find fascinating is that people think that they can do this not only in England, but even worse, where people think they can do it from another country. So they're going to do rent to rent or rent to buy and rent to lease back and all of these fancy things, and they're going to do it from a different country. I'm not interested in trying to, it's such an overcrowded market, and in anything that's overcrowded, it's very hard to find good opportunities. Assets where you don't get the right information. So this is an important one. So a good example would be India. So I'd really like to invest in India. I think India is the future. I have no doubt in my mind about that. But it's very difficult to get the right information. A good example of this, I was in Shanghai in 2003. I was trying to buy property, believe it or not, and in 2003. And if I'd achieved it, I would have done really well because property has gone up 4 or 5 times in that time. The problem was I couldn't buy lunch. And you think I'm joking, but in 2003, no one spoke English. I could not buy lunch. I tried to buy a plane ticket from Shanghai to Bangkok, and I literally couldn't do it. We had to point to two on a world map. We had to point to the 2 cities, and it was a shit show just trying to do that. And I just was thinking to myself, what are the chances of me being able to buy a property here? It's zero. I'm going to get scammed. I just couldn't get the right information. And it sort of leads into the next one, which is where you can't find the right partners. If I could find the right partner on the ground in Shanghai, then I would have done it. No problem. But I didn't have the right partners. And the same thing in America, etc. So this is crucial for us. We've got to have the right information, got to have the right partners. And then lastly, in countries we don't understand. So Southeast Asia at the moment, there's massive opportunity. Vietnam, there's massive opportunity. And I've been on holiday there. I sort of understand the country a little bit, but I don't know how to get in. And so it's a lot harder to get into new countries for us, which is why we tend to have stuck to America, to England, to Europe, to Australia, because we've been doing it for more than a decade in those markets. And so when we go, I've tried to get into Dubai twice. And, for various reasons, it's difficult to get into countries until you've got a track record, until you understand them and got the right information, the right partners. So we don't just spray and pray around the world. It's very, very, it takes a lot to go into a new country. I assume, Nadine, when you say, are you talking about house realty, the mom and pop investing? So I think we're saying the same thing, which is, yes, it's where mom and pops go out and they buy houses, and they renovate them and they let them out, etc. It's what people have done for 25 years. I've done it. I helped 2,500 other people do it. I did it 16 times myself. But there's much easier and safer ways to make money nowadays. So if we go to those top 15 assets, you can see the reds are what we don't do. So we don't do stocks, we don't do bonds, we don't do cash, we don't do mutual funds, we don't do derivatives, we don't do currencies. We do real estate, we do commodities, and we do ETFs. We do private equity, we do venture capital, we do cryptocurrency, and we do infrastructure. We don't do hedge funds and arts and collectibles. And then lastly, if you want to look at our top 15 focus, not in any specific order, we do commercial real estate, multifamily. So this is where you buy 700 units in America. It's an institutional way of investing. So, rather than buying one apartment, you buy the entire apartment block and you run it like an institution. Industrial, so, industrial logistics. Everyone knows about e-commerce. There's a massive need for logistics. So industrial, MOB, which is medical office buildings. So medical, you got to be careful in medical. I thought medical was bulletproof, and then COVID kind of exposed that. But the point being is that people, particularly in aging communities, medical is always going to be something people need. You just got to be able to get it right. Office, again, people thought with COVID that everyone was going to work from home forever. Well, they're not. Everyone's moving back to the office now, or certainly a blend of office. Co-living, which is a way of living where it's not for students, but it's kind of from the 25 to 40-year-olds, where they're living in smaller spaces, but they've got all the different amenities. One of the fastest growing institutional assets. London residential, you're going to learn about that right now. It's really an amazing thing that I really look forward to sharing with you around how to do London residential, but doing it large scale at an institutional level. First mortgage debt, again, one of the fastest growing assets in the world, which is basically replacing the banks. So, we did a deal in Manhattan 12 months ago where we're getting a 10.5% return in dollars in Manhattan, and we effectively replaced the bank. Retail, so that's where you're buying, shopping centers, etc. We tend to try and look for, things where they're lifestyle shopping centers, not things that are going to get taken out by e-commerce. Senior living, aged care, I think that one's fairly self-explanatory. Mixed use, so it's a combination where you've got different uses within a building infrastructure. Data centers, this is probably the one that I and Alex are most excited about, and yet it's been the hardest one to actually find partners and opportunities to be able to get access to them. To put in perspective, the demand for data centers doubles every 6 months, and yet it's got constrained supply. So it's kind of an exponential gap, and it's a kind of a no-brainer. ETFs and the stock market. So, you should be exposed to the stock market. And if you're going to do it, the most effective way to do it is through an ETF. And Ann Wilson is the best, to my knowledge, in the world at teaching people how to do that. Structured notes. So again, structured notes are something that our VIPs spoke about yesterday, and something really, really interesting in terms of a great way to invest like an institutional investor. Gold and silver. Private equity. So private equity, we're going to learn more about on Thursday as an opportunity to be able to invest. Venture capital, and then finally crypto. So I don't know if you want to copy me, model me, master me, screenshot that screen, but those are the top 15 at the moment that we're looking at. And we've actually got a thing called asset class mastery. And again, you as a wealth hacker, you get access to this. So if you go back to our classroom, you've got the Wealth Going Global, which is I've shown you today already. But if you go to Asset Class Mastery, you can go into each one of these assets. So you've got structured notes, multifamily, medical office, and each one of these is a 90-minute to 2-hour training course. But what I always say to people, it's not about going to Harvard. Anyone can go and do a course on structured notes or multifamily or industrial. That's irrelevant. This is about getting access to the right partners. So this is the top sort of 15 partners around the world in these 15 different asset classes. So they're not only teaching you about the asset class, but they also are teaching you, like they're doing it themselves. They've been doing it for 10, 20, 30 years. And so you're not just learning about data centers, but you're actually learning how to invest alongside them in data centers in terms of that process. Does this make sense? Are you starting to understand the tip of the iceberg here? Any questions? Anastasia's saying she's overwhelmed. I get that, Anastasia, and I remember that I showed you that I told you yesterday that I was going to show you what you need to know, and then I was even going to show you where to get it. So I'm not going to leave you. I'm never going to leave you. I'm not going to leave you hanging. I can't. It's impossible for me in 5 morning sessions to teach you everything. It's impossible. But I am going to show you where to get everything in terms of the information. So what I want to do now is I want to pivot, and I want to give you an example. So there's the 15 different asset classes, but the one that I wanted to choose was London residential, because there's very few people in the world, no matter where they live in the world. They can live in America, they can live in Australia, they can live in Hong Kong, South Africa, or Timbuktu, that hasn't had an aspiration at some point of owning a property in London. And so my logic is, well, you kind of got mom and pop investing, or you can invest like an institutional investor. Now, there's a gentleman that I've known for a long time. I've been working with him since, I don't remember exactly, but I'm going to say 2007, 2008. So I've known him for 17 years or more. And he's one of the most respected people in the British market. And he'll tell you his story now, so I'm not going to repeat it all. But why I wanted to show you this interview was because this is just one example. So I've given you all 15 assets, okay? We don't have time this week to go into each one of the 15 assets. But I wanted to give you an example of one of the assets, London Residential. Now, just while you're listening to Gary and going through London Residential, remember that there's 14 other assets and there's 14 other Garys. Every single one of the assets, we have a partner like Gary in that asset. And what I want you to do when you listen to this is I want you to listen and to learn and specifically think, what have I been taught as a mom and pop investor and why is this different? And after everything that Scott's shown me today, between the different countries, the different currencies, and specifically the different assets, how can I do it differently? How can I set myself up for success? Because remember, tomorrow when we do asset allocation, I want you to have the peace of mind to know that everything we're going to teach you tomorrow is possible because today you've learned about the different assets and I've shown you how to get access to the partners. Is that fair? Okay, so let's rock and roll with Gary. He's an amazing guy. He's got a lot to share with you, and I think it'll be very, very valuable for you. Gary, it's wonderful to have you online. Thanks for jumping on. It's always a privilege and a pleasure to learn from people that are on the ground doing it. I always joke with people, we could bring in Harvard University professors and, London Business School economics professors, and they tell us all the rhetoric about what's happening in the market. Or we could do it with someone that, owns hundreds of millions of pounds, has developed billions of pounds, and probably has a better pulse on what's happening in the market. So do me a favor. Give us the précis version of your story, how you got to London, and how you ended up being one of the biggest developers in London.
Well, not one of the biggest, but we've done okay. So I left South Africa in 1987 when I was 2. No, I'm kidding. I finished university. I went to Wits, came to England, actually started a little furniture shop. And kind of instead of waiting for customers to come in, I went out looking to all the estate agents. Furniture, and just a little bit of history of you own the furniture. So in other words, if the tenant owned the furniture, it was difficult to get them out because their goods and chattels were there. So I kind of transitioned from there to kind of being in the early 90s, was a bit of a property boom. And slowly but surely, I started buying a flat here and a flat there and turning them and et cetera, and selling them. Until that went into developments, and we'd buy a whole development, as you talk about, but we didn't hold them. We didn't have the capital to hold, so we kind of flipped them. It was much easier in those days in terms of getting mortgages, etc. And then we kind of transitioned into saying, you know what, why are we selling this stuff? Can we not keep it? And most of the time we've used our own capital and made it sweat and built up a business that today we are holding nearly 1,000 units with another 300 in the pipeline. And really the basis of this is, I'm sure a lot of you on the call know Natie Kirsch. And in 2009, it was impossible to get debt. And we had a development going up just to the east of Canary Wharf at the Excel Centre where the cable car is. And Natie funded me, and he said to me at the time, he said, Gary, he said, I'll go into this deal. He said, we've checked you out. We think you're honest, etc. He said, but he said, I don't know how clever you are, but even stupid people can make money in property. He said, just don't sell it.
Sorry,
and that's very key.
Just repeat it there. Sorry, because I know you well, and you drop these little gems in and people miss them. So just remind everyone what you just said there from one of the wealthiest people in the world.
He said to me, he said, Gary, I'm not worried about doing this deal with you because even stupid people can make money in property, just don't sell it. Which is great. You know, you have to generate capital to keep on building. So, you know, you can get to a point where the market gives you a lot of luck, or you can create equity by, for example, planning plays where you buy a piece of land and you get a planning permission, etc. It's just the higher risk stuff that creates equity. And then you've got imputed equity. And that's how we've done it up to now. And in fact, now we're kind of looking at external capital to come in and to fund us. And that ultimately is where we're going. So you have to understand there's been a transition in England. England's famous for saying, you know, your house is your castle. And that's always been, you know, people always trying to buy their own property. Just to give an idea, in England, home ownership sits at about 65% of the population, which is enormous. That is absolutely enormous. But what's happened, and it's happened in the world, is as costs have gone up and as prices have gone up, it becomes more and more difficult to buy properties. It was easy up to the financial crash in 2007 because credit was available. As credit tightened up, it became very, very difficult to buy property. So there's been a transition to rental property. Now, that really comes down to the credit markets, because if you think about it, rent is the ultimate form of credit. Okay, so, you know, if you go back 60, 70 years ago, the first consumer credit was really on cars. And that was because the car manufacturers making a huge margin. How do they get more cars sold? Is they offer credit. Okay, so, you know, and as long as and then they're actually making money on both sides. They're making money on the margins of the cars and on the credit. So what's happened in England is as prices have gone up, credit and credit has tightened up, the rental market has increased. Plus, I think it's included as a general world position of more of a nomad generation where people want to be flexible, want to move. I would guess that out of choice, people would prefer to be homeowners, but they justify being rentals, having a rental, being in a rental because they kind of think it's kind of trendy, etc. And you can kind of get more value. What you don't have to do is invest in a massive deposit. So actually, over a life cycle of someone that is renting on a cash flow basis, it probably works. You know, if you offset the additional rent you're paying to what it might cost you on a mortgage, and you take the cash flow of the deposit, it's probably about break even. But what that's created is it's changed the rental market in the UK quite dramatically. So from moving from single, maybe a portfolio of 4 or 5 units as people see as a pension for themselves, which, as you alluded before, starts becoming a nuisance to run. And that's mainly because if you have a portfolio of 5 and one tenant doesn't pay rent, you've got a 20% hit on your portfolio.
Well, even worse, most international investors have a portfolio of 1, and then if that tenant doesn't
correct.
pay,
Correct. So Scott, if you go back a few years, we kind of pioneered rental guarantees.
Yeah.
And the reason we did rental guarantees was not so much and this is, by the way, is when we were selling stock. And the reason we did rental guarantees was not so much to get better prices on our properties. It was to give the confidence, okay, to buyers that they knew their cash flow was secure. And so if you think about it, we had a development of 100 units, and Joe Bloggs bought 1 unit, and Dave Smith bought a 2nd unit. One of them would rent out first, and one of them would rent out second. One of them may have a tenant paying or not, etc. So if you do that over 100 and you consolidate that on, say, a rental guarantee position, that risk is reduced dramatically. Okay, so and reducing the risk, and what you really want is investment in property. You've got to understand property is a long-term investment. If you make money on property in the short term, it's because you're lucky with the market, and you can't predict that. You have to actually be lucky. You can take certain factors, which is what we're doing, and kind of use those factors to your advantage. So just for example, like we're noticing now, there's a huge lack of supply. So one can turn around and say, well, if you look at a macroeconomic position,
Well, if you don't mind, I'm actually just going to chuck up a slide of yours from when you presented in August, just while you're talking about this, just so people can actually see what you're talking about.
Oh, okay, fantastic. Okay, so we've kind of adopted a kind of a macro policy on the basis that you've got to look at 10, 15 years on property to really get your income. Otherwise, you create a market risk. And we kind of say, well, use what we understand to reduce that risk. We're all about risk reduction on the basis that even stupid people can make money in property, just don't sell it over the long term. Okay, and don't get me wrong, if we get offers on properties that are fantastic, we will sell, but our preference is not to. And also, by the way, you reduce a lot of frictional costs, but I'll come back to that. So we take the macro philosophy on property and say, well, demand is restricted. So if you think about it, what we've gone through since 2007, we had a financial crash. The markets really dipped, but they came back quite strongly because there was a huge wedge of cash waiting for a dip market. And we had a good run between, say, 2012 and 2016. We kind of then started tightening up. Then COVID came, reduced construction. No new developments were really started during COVID. We finished a 700-unit development throughout the period of COVID. So we were very fortunate. Cost increases went up dramatically. So viabilities that developers had done stopped working. We then moved into this high interest rate environment. And for those of a similar age to me, which are probably not that many of you there, but, I lived in South Africa at one stage with 25% interest rates. So the generation that exists now is very used to low interest rates. I don't believe interest rates are going to drop for another 2-3 years. And I don't think we'll see for a long time that 1-2% positions. So that has dramatically stopped supply. It's particularly in London. And by the way, Scott, as you know, we're London-centric. Okay.
Yeah, well, I was about to pivot. Once you finished on the fundamentals of supply and demand, I was actually going to pivot to this one of why London, because again, it's one of the capital cities of the world, but I'll let you talk about it. But ultimately, I don't think there's many investors that don't want at some point say they own a piece of London.
Yeah, look, the benefit of London is the stability of the legal system, okay, or of England as a macro. As a micro, everybody really wants to be in London and England. If you look at the demographics of the country, there's this huge kind of swathe up north, etc., and there's this kind of leveling up policy. But the truth is, people live out of London on the whole, in places like Birmingham or Manchester, because they can't afford London. And what you're finding is London is equalizing with those areas, because there's been a bit of a boom in Birmingham, Manchester. But what you find is in a down market, and that's how we plan. We plan for a down market. So if we can't make something work in the bad times, we don't want it. Okay, so and so London is pretty strong, and the shortage in London is dire. So just to give you an idea, London needs about 60 or 70,000 new units per annum. And I think like the average over the last 5-6 years is probably 18, maybe 20,000. So it's created a real shortage. That's when Scott was talking about co-living. So co-living is happening. There's what can happen is you can get smaller units. So what happens, you get like a unit going, an average unit, say 650 square foot, 700 square foot becomes 300 square foot. The only problem with a unit like that is you can only sell it for the income. You can't get any capital growth because you can't split it. So you have to sell it as a building. What we've opted to go for is a mixture between the two. So we are taking regular blocks, which can be split up, but consolidating them. And the theory behind that, having dealt with the macro side of why we're doing it, the theory is, how do we reduce frictional costs? Okay, so when you're a developer, you're going to develop, and if you take your cost, the general margin, profit margin for a developer is between 20 and 10%. Okay, so let's just talk, say, 15% profit on the gross development value, the GDP of the development. So as a business, if we can be vertically integrated, that 15% margin is we keeping. Now you take out the frictional costs. We don't have sales costs. That's going to cost the developer 5% of any development. We don't have further stamp duties, okay, to hold the stock. So if I sold an individual property to an individual investor, they're going to be paying me my 15%. They're going to be paying 5% of the cost that I've had added on for sales costs. They're going to be paying stamp duties. You know, it doesn't take you long to get to 18%. And then when you take the margins at 18%, that's quite a big difference. We also in an environment, obviously, where we've got increasing costs, okay, and a limited land supply. So for anybody that understands basic economics, sorry, if you don't mind, I'm just going to close the door because my dogs are going crazy. Just bear with me.
No problem. Yeah. So just a couple of things to simplify what Gary's saying. In simple terms, when he's talking about cutting the friction costs, what he's saying is just cutting out the middlemen. And if you remember where I showed you the value chain of real estate, I said you could be investing at the end, which is what Gary's just saying, with all these costs all the way along, and that dilutes your return. That's why you never get out of the middle class, because your returns are middle class returns. Or you can go up the value chain, cut out all the middlemen, and that's exactly what Gary's talking about.
And of course, by the way, Scott, you're reducing the risk, as I said before, because you've got a development of 100 units, okay, and you're going to have a small percentage of bad debts. I think our non-payers and our voids run at about 1.5 or 2%, which is very low. Very, very low. So we're running, as you know, we actually have just sold it, but we owned an estate agency, which we started from scratch called Life Residential, where we manage the properties. We sold it last week, actually, but we were running 5,000 properties in London. And I think our voids were like 45. You know, it was unbelievable. So, you know, everything is kind of brewing to make a really good cup of coffee in the residential market in London. Okay, so what you're finding is there's a lot of capital coming in for what they call build to rent, BTR, so kind of professional landlords. What that's done is it's increased the quality of the properties to some degree, but it's also increased the prices, because what happens is now you've got commercial competition. So I'm building a building, I need to put in a bloody nice gym, I need to make a community that people want to live. So it's all about customer retention. And suddenly, instead of us being a landlord, we're actually we're a business with customers. So we don't have tenants, we have customers, and we treat our customers like hotel guests. Of course, that's got slight increase in costs, but the relative cost increase is far less than the relative rent increase we can get, because people feel part of a community, they feel valued, etc. And so that's kind of the direction that we have gone and that we are going in. Okay, so we're trying to, and then the risk profile of the development, of course, is what you do. Do you buy a piece of land and take the risk of getting planning? And you must understand, when you do that, if you don't get the planning, you've kind of lost your money. You've got a mini field. Okay. If you can get that margin, that's how you make your most margin. So, you know, it's a risk return. The development risk we don't really see as a risk, because we tend to close our contracts in terms of the construction, etc. So just to give an example, through COVID, okay, we built, as I said, we built the tallest tower in West London, 57 stories, 700 units, and that was constructed through COVID. And believe it or not, our entire cladding came from Wuhan. Okay, so you can imagine our kind of blood pressure when COVID started, but we closed the contract with the contractor, so we had zero cost increases. In fact, we agreed to pay, I think, on a £200 million contract, we agreed to pay $1.5 million, and that was shipping costs, because shipping containers went up hugely during COVID, and so we agreed to pay some of the costs. And it was just a gesture of goodwill because of the amount of business we do with the contractor. And the Chinese cladding company also took some of the hit. So we kind of reduced that risk. And so the development risk we're quite comfortable with. We're super comfortable with the rental risk, because the supply and demand, it's going to take, I don't think it's soluble, actually, or solvable, actually, is the word. It will take 20 years at London at full capacity to build, to catch up, to actually provide the stock. The planning system in England is so bureaucratic and so difficult to navigate And just give you an example, when I say about costs and difficulty of planning and restriction of demand, as you know, very sadly, there was the fire in London at Grenfell Tower. Now, the fire at Grenfell happened. It was a perfect storm. The building had bad cladding put on. It had no fire sprinkler system, etc., etc. So if you compare that building to one of our buildings, completely different. It's chalk and cheese, right? So we have full fire. In fact, we have the highest possible fire rating in our buildings. But what, in their wisdom, they decided to do was to say to anybody building a tower, and it went from 18 meters, from 30 meters and above down to 18 meters. Now, think about 18 meters. That's not that tall a building. That's like kind of, I don't know, 7 stories, 6, 7 stories. And they said, right, you have to have a second means of escape, a second staircase. Now, the rules in a tall building from a fire perspective is stay where you are, because you've got a fire system that works and that functions individually in every single room in our building. So obviously they kind of cracked a nut with a sledgehammer and decided to put 2 staircases. Now think about what that happens in a building. You're just taking out 10% of your usable space, which increases the costs. So you have a situation where a lot of developments aren't viable, and a lot of architects have had to go back to the drawing board and redraw up. So that's just another addition to the restriction on supply. So when you look at it like that and you say, okay, we've taken out we understand the development risk, we understand the rental risk, we understand about taking the frictional costs, you can start working to getting a fairly decent return. Now, the cash on cash return starts becoming damn close to what the banks are paying now. Okay, of course, it's not liquid, but it's a cash on cash return. And I keep saying, I have friends that come to me and say, you know, we've done okay in the property business. Can we buy a flat for our kids, etc.? And I always say to them, I say, you have to understand, I'll sell you the flat, I'll give you the biggest discount I can, but you have to promise me, okay, you're going to keep it for at least 10 to 15 years. And I say to them always, and just to be sure that there's no misunderstanding, I'll give you a guaranteed buyback in 15 years at the cost you're paying today. So you cannot lose money. Okay, the absolute number. Of course, you're going to lose the income, but you cannot lose money, because that's how confident we are in terms of the prices going up. And you just have to look, you know, when I come back to South Africa, I just think of a place like Shelley Beach, where my parents had a timeshare in 1980, say 3. There was nothing there. There was a row of townhouses on the beach. Now there's a whole city. Okay, and that's like over a period. And the same is happening in London. You might be able to show a couple of the slides of what I'm talking about, Scott, about the regeneration.
So just before we go to regeneration, Gary, I want to go there. But just before we go there, there's a question from Stephen, and I think it sort of sums up with this slide I wanted to show. So when you're an international investor, the first thing you get offered often is Birmingham and Manchester and Liverpool, and there's lots of students and they need lots of student accommodation, and developers kind of sell to them. And I mean, I've heard this story. You and I have been doing this nearly 20 years together, and I've heard this story so many times, and I'm virtually almost yet to find people that make money doing this. I'll never forget in Manchester where 100 South Africans bought, you know, student accommodation, but it was 20 miles. I mean, that's like 36 kilometers from university. And when I was at university, trust me, I didn't want to live 36 kilometers from campus. Like, and needless to say, they couldn't rent it out. Like, you know what I mean? So these things all sound a hell of a good on paper, and then you have real life happening. And I just want to kind of reiterate, I've got a question and I've got a comment and a question for you quickly before we go to the regeneration. This for me is the difference between what I'm going to call that mom and pop investing, which is where I can't afford London. So I tell you what, I'm going to go to Liverpool or Manchester, and I'm going to buy an old house, and I'm supposedly going to renovate it long distance, by the way, which is now and impossible. Then I'm going to manage it. Then I've got one tenant with one, you know, management agent, hopefully going to get it. And there's all these risks. Or I could invest with a partner that literally is building the development, is owning the development alongside me, is managing the development and cutting out all the middlemen. And that just, I want to try and explain to people, that's the difference between what I call mom and pop investing and institutional investing, which is what Gary's trying to explain. I don't know, Gary, if you've got any comments on that before we move to the regeneration.
Well, just reading Steve's question. So, Steve, you're quite correct. There's been a huge flood of capital into the student market here, and it's it kind of defies belief, really, the amount of quantity that's happening. But what you find is that people jump on a bandwagon, and eventually there'll be oversupply. But people doing that are competing with funds. You've got massive American funds. You've got massive university endowments that are buying these properties, and it's difficult to compete with them. So, yes, you're getting a return. The capital returns on a student development? Here's a very subtle point you have to understand, okay? The returns on a student development are purely based on income, okay? So let's just say, for example, you've got income at 5%. You've invested £1 million, right? You've got income at 5%, so you've got 50 grand coming off your investment. That money is valued purely at a multiple of an investment. So if the market and the cap rates on student accommodation is, say, 4%, you'll get a multiple of 25 on your income. Okay, and if interest rates go up, that will reduce. Okay, you might be expected to get 6%, and then you've got a multiple of 15.5, whatever the case is. Okay, so on residential property, you have the income. The value you can also sell because of the build to rent market. You can also sell on the cap rates. And by the way, if you look at any of the cap rates in the UK, residential property is the best cap rate and the most stable cap rate right through COVID, right through running between, at one stage, 3.25 to now it's sitting at 4, whereas like the equivalent commercial is sitting at a cap rate of 6%. Okay, so the multiples are much more. But if you split up that building, you can also get the capital growth. Now you're talking about price per square foot. Okay, so income is generally based not on price per square foot. It's based on the market, etc. Price per square foot often has no correlation. In a buyer's market, has no correlation. I mean, I've been in an exhibition in Hong Kong when 20 years ago, where we'd go in, and we started on a Friday selling properties at £650 a square foot, and by Sunday we're selling at £800 a square foot. Okay, which is like ridiculous. So that is the one fundamental understanding of what we do in terms of rental. Okay, so your exit and your IRRs and exit can be much, much higher than say what a student ultimately can be. Okay, a student accommodation. Very stable, great business, and there's been a huge surge. If you just look at the planning applications, people are planning a student and co-living, but it's really simple. Why? Because they're smaller units, and you're going to get higher income on a smaller unit. You know, you're going to get relatively more on a 1-bed flat as opposed to a 2-bed flat from a cost perspective. Okay, but how do you sell that? You can only sell it based on the income. So you're not getting involved in property, you're getting involved in capital markets. Okay, and the people that should really get involved in capital markets are banks, funds that deal in money. And for the individual investor, you're not really dealing in money. You know, you're not saying, oh, I've got £50 here and tomorrow I'm going to invest it here and then I'm going to put it there, etc. You have to look at a long-term strategy. Our strategy actually is so simple and so old-fashioned, but it works. In fact, I had a guy I know, a big agent in London, said, you know, Gary, I've known you for years. He says, you're one of the only guys that I know is still doing the same thing you were doing 25, 30 years ago. But, you know, it's kind of old-fashioned, landlord and tenant, but do it in a much better way. I recommend a really good book, and the philosophy that we look at from a tenant perspective is the guy that started Four Seasons Hotel, Isidore Shah. And he has a great biography, and where he says, put the customer first and foremost, okay, and everything else will follow. Okay, so sorry, Scott, and one other thing that we do is we tend to fix our interest rates. Okay, so in the good times, we kind of fix them. In the bad times, we let them float. Risk reduction. That's all we do, risk reduction. We don't expect to make massive money, but we will, when the markets boom, we will make a lot of money. But we make very solid returns.
Couple of comments there. You've just taken people from a school level to an honors degree to a master's to a PhD talking about cap rates and everything. I'm sure for
gray hair
like went straight over their heads. But my point being is that it's that type of stuff where not only in the VIP, I'll go into a lot more detail if people want to understand it, plus Wealth going global. Gary, I want to come back to the fundamentals. And one of the things that I've learned from you and been part of with you is focusing on regeneration areas. They talk in property, location, 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 but equally they say in property, try and buy property with a twist. So talk to us a little bit about just, and I can put up the slides for you quickly. I don't expect people to be able to read all the slides, etc. But the point being is that if you want to just talk to us a little bit about the fundamentals of regeneration, and then also why you're now in West London and what the opportunity is in West London.
Okay, so the reason I'm in regeneration is because I could never afford to buy stuff in established areas. Okay, I could never create value. Whereas in a regeneration area, you can kind of create value if you have the vision. And that's one of the things about my experience when I mentioned about Shelley Beach is when you leave somewhere and go back over a period, you can really see the growth. So if you go back to Sandton, for example, 30 years ago, there was nothing. And if you go there now, it's unbelievable, right? So
you've got a good picture for
okay, so correct. So that's kind of on the left. On the left was kind of when I kind of came to England, and I kind of liked Canary Wharf because you could go and rent something in an established area, was a bit old, a bit damp, etc. And yet you could go to Canary Wharf and rent something that's fantastic. It goes back to how the customer feels. Okay, and then we admittedly we rode that. So, and East London, the history of East London was it was seriously bombed out during World War II. And people and so it created a great opportunity. The buildings were built to a large extent because in the first instance it failed. Why? Because the infrastructure wasn't there. They hadn't put the tube line in, et cetera, et cetera. It's ultimately done. It's unbelievable, the growth and the change. So we kind of looked at that, and we happened to be based in West London, and West London is going through a transition. And West London actually is a bit of a no-brainer because it's much closer to the center of London, okay, than East London. But we were given a gift in the fact that they decided to build, I don't know if you guys follow the UK news, but you would have heard a lot about HS2 and it being cancelled. So HS2 is the high-speed rail link, which they were doing between London, Birmingham and Manchester. And in fact, they've just cancelled. It's gone so much over cost that they just cancelled the Birmingham to Manchester route. So we've ended up in a situation where we have the largest station. On the left is what were shunting yards. And now you can see on the right, and I could give you an updated photograph. It's ridiculous, the amount of construction. And so there's become a whole town centre. So we are in this location, we are by far the best connected position in London. So we are in zone 2. So imagine zone 1, zone 2, zone 3 of the tubes. Canary Wharf is zone 3. We're in zone 2, so we're much closer.
There's a map.
And
just find your map. There's your map there, basically. Just to
yeah. So if you kind of point out where West London, White City, you go a little bit left, stop a little bit left there, stop there. That White City, you may have heard of White City, a massive development, the largest shopping centre in London. And then you've got to the right, Westminster, and then you've got Canary Wharf. But the point is, in West London, the infrastructure is there already because the Elizabeth line, which runs east to west, comes straight through there. And then you've got HS2 and the tube. So that's why they chose the location, because it's where all three transport facilities meet. And so the infrastructure is there already. So, and we kind of pioneers, if you're just looking at that picture that Scott has on the right-hand side, just to give you an idea, this picture is taken from the 57th floor of a building that we've built. And if you look at the end of the triangle, but to your left with your mouse, that's another one of our buildings being built. That's going to be ready in April. We have another one across the road. That's investments I'm talking to Scott about getting involved in, which is up to a third floor to be ready in about 18 months, 19 months time. Imagine in that triangle is going to be the largest single station in the whole of Europe, not in London, in the whole of Europe. Okay, so anybody coming from Birmingham will be ending up there. So you've got regeneration. And in fact, Scott, yesterday, you might well all know Ballymore. Ballymore, in my opinion, are the best developer in London. They create the best infrastructure. Well, just to the right of that development that I'm saying there, just if you go up, that, by the way, that big green area is called the Scrubs. It's like the third biggest park in London. And if you go just slightly up from there, there's a bunch of brown buildings. There you go, left, right there. Ballymore has just announced they've done a deal with Sainsbury's. They're building 2,500 units there. Okay, so if you think about what's going to cost them to build, if you think about what our cost is because we're out the ground already, and you think about the change in the area, that growth could be huge. Okay, so here's this investment philosophy. Okay, so we're taking something which works today and giving you pretty good returns. That, by the way, what you're seeing is, if you look in the right corner, you can see the building before we built the area and what we built. That's a great sign of regeneration. And if you can have the vision to say, where, so Scott will tell you, a lot of people, when I started building that building, they said, you're crazy. Now they think I'm a miracle maker. So this picture that Scott has got up is we are built now. The 3 orange buildings in front is Imperial College. Okay, they've got planning permission. They're about to start building. So that whole area is going to transform. All that area that you can see behind is part of the HS2 redevelopment. That's all, and the stations, all part of the HS2 redevelopment. So here's the investment. Okay, we know, and we work on current rates, current rents versus current interest rates to make a return. You might not get the 6, 7, 8% return on cash and cash. You're probably going to get net 4.5% return cash and cash. But think about the massive growth between now and 15 years with the regeneration, where all of a sudden you're sort of in central London, because central London is going to move towards the west because of the density levels. So, and at that point in time, unlike student accommodation, you could choose to break up the building and sell individual units, and think of what the cap growth is. So over the period, the cap growth is there. And we all have to look historically, how did our parents buy a house for £10,000 in 1960 FTSE, okay, and then end up with a house that's worth £2 million today? How did that happen in a relatively short space of time? So, I think that it's quite a subtle understanding to say. So my view is, if you'd say property as a long-term investment, you buy efficiently through reduction of frictional costs. Okay, you end up and you hold it. You just have to hold it. And over time, you can grow it. It will grow naturally through supply and demand, increasing population. Okay, as they say, God has closed the factory of land. He's not building any more land. Okay, he's closed that factory. So supply is going to be reduced. You're increasing costs, etc., etc. And then you've got the addition. Okay, you have the absolute addition of the regeneration factor. Just where my per square foot cost today is not going to show any relationship to the per square foot cost in the different place, a bit like a place like Sandton becoming from going from one price to another price over a certain number of years. And that's really the philosophy of the strategy. And as I say, we've always tried to do it ourselves and sweat our capital, but obviously you can't keep holding property without sweating capital unless you can get credit. So, and that's why we're looking to kind of consolidate and make a fund. This what you're looking at now, by the way, is our platform for rentals, etc. Okay.
I'm just sort of showing people because they call them trophy assets, aspirational, whatever you want to call it. And it's like so many people, Gary, even when you and I were doing this 15 years ago, it took a hell of a lot of money even to buy one apartment. And then you had to go set up an offshore structure, and you had to get a mortgage, and then you had to manage the property and the hassle and everything in between. And, what I love with what you're saying, and in simple terms, is that in the past, you used to, I would help work with you, but we would help someone buy an apartment, and then they were kind of on their own, like go and own this apartment. Yeah, there'll be a management agent, whatever, but it's kind of yours. Nowadays, you can partner with you in the development. You're owning a piece of the building. I'm owning a piece of the building. Joe Soap's owning a piece of the building, and we're holding it for 5-10 years. And you've got a full management solution, cutting all the middlemen out, which obviously is increasing the return, reducing the risk. And, when we exit, there's multiple exit strategies, whether it's selling them off individually or selling them to an institution or whatever. Have I summed it up, in simple terms for people? Yeah.
You know what? Can I give the bottom line? We're in the business not making money. We're in the business of not losing money. Okay, so we start off with the premise we don't want to lose our money. That's the first thing. So if we break even, we're happy. We know that we'll make money over the long term. It just depends how patient you're prepared to be. Okay, that's the fundamentals, right? So one of the biggest frictional costs now, of course, is finance. Okay, if I can be a cash builder and developer, okay, we probably pay 10% for our money just on the development side. So if you start stripping it back and you're cash and you've got a group of investors and you're building for cash, okay, the margins are enormous, okay, but over a longer period.
Yeah,
the IRRs become huge.
Well, look, I've squeezed more time out of you than I asked for. So you promised to give me 15, 20 minutes. And Cheryl said, how can I get in touch? Cheryl, between Gary and I, we're going to be putting an opportunity together. It's going to be on the Wealth Migrate platform. People will be able to invest directly alongside, with Gary and the team from a partnership perspective. So yeah, just watch the space. It's literally, funny enough, while Gary was on live, Ian Cohen, his partner, was phoning me going, hey, we need to do the numbers because we were having a meeting yesterday about the numbers. So it's a work in progress in terms of where we're going.
Scott, there's just one question I just saw from Caroline, just questioning on overvalues and what is the value of a property. So Caroline, my belief is the value of the property is the income it produces. Okay, that's very simple. If it doesn't produce an income, what's it worth? It's worth whatever anybody will pay for it because they fancy that property. Okay, with residential property and the liquidity of residential property, it's worth what the income is in today. But you know what? At some point in time, there'll be someone that wants to buy that property from you for an inflated price.
You know what I love, Gary? You were on an hour and a half ago, and I literally started an hour and a half ago, and I showed them all the international markets. And I said, whether you own a house to live in or you own a house to rent, it should be based on the income of what you can get for it. So the nice thing is...
Scott, interestingly enough, the people that buy the house to own to live in, it doesn't matter. It's your home. As long as you're happy there and you can afford it, doesn't matter. And that's why people pay. So if I've got a really nice home, someone will buy that from me at an inflated price because there's a real value to that. At this moment in time, majority of the market is just income based.
Yeah, no, brilliant. Listen, I'm going to bounce. Thank you very much for your time. I really, really appreciate it.
Absolute pleasure.
A hell of a lot of questions.
I hope your weather is all better than mine. It's crap, London.
There's a hell of a lot of questions that come up. Shane will be taking them all, and I'll be answering them in the VIP room. But this, I'm sure, will not be the last time Gary and I chat. I always joke with people. Him and his partners pioneered furniture packs and rental guarantees, and everything 25 years later, so that international investors could get into the London market. And what I'm really excited about is with him pioneering this buy-to-let space or buy-to-own space using technology now, and it's going to be a game changer for everyone. So thank you, Gary. I'm really excited.
And if anybody ever comes to London, feel free to contact me, and we'll take you around, show you with pleasure.
Awesome. Keep on, mate.
Cheers, guys. Thanks very much. Bye.
So, what did you think? Pretty cool, huh? Thanks for all the comments from everyone. So, for me, when I took you through this asset mastery, and if you remember, I went through here, and actually, if you go to London Residential, here, it's Gary taking people through London Residential. So, but this was one that I wanted to share with you so that you could really get an essence. Like, are you starting to understand now when I talk about mom and pop investors, and now you see Gary and you're like, well, I can be a mom and pop investor. I can go and be retail and go buy houses and renovate them and blah, blah, blah. Or I can invest alongside Gary. Like, he's putting his own money into the deal. We're going to talk about partners on Thursday and how to find the right partners. But he's putting his own money into the deal, and you're going to invest alongside him in the deal. Can you see how, again, in my opinion, I'm not giving you advice, but in my opinion, it's a lot less risk with a far better opportunity of return. Like, does that make sense? A lot less risk with a far better opportunity of return. So I'm just glad there's some lovely comments here. London, here I come. Told you, Benson. I told you it was going to be possible. And Mama Dupe, lovely to see you here. Judy speaks very, very highly of you. And Alex has sent you a private message as a bit of a gift, because we'd love to invite you to be part of the VIP room. So I look forward to seeing you in the VIP. As I said, Judy speaks very highly of you, and I really look forward to meeting you. Our business is in the business not to lose money. Yeah, no, it's he's a lovely guy. So his name is Gary Sachs, and the company is City and Docklands. Just trying to see if there's anything else that's relevant here. And Jan's saying, so switch mom and pop to institutional. Yeah, well, if you think about today, and I'm going to start wrapping it up for you now, but if you think about today, like what do? We went through the value chain of real estate. I showed you where the mom and pop investors are investing, and I've now shown you how you can go up the value chain and invest alongside, the developers and basically play where the institutions are playing. Like you can start to see how different this whole game is in terms of this process. So I wanted to share with you another, and we don't have time now, but another great friend of mine is a lady called Ann Wilson. And in the resources, she actually did a presentation for us on ETFs and how to get into the stock market. Now, in my opinion, she's the best in the world at teaching people how to get into the stock market. So that's in your resources. I'm not quite sure why we give you so much stuff for free. We could be called Robin Hood or Mother Teresa, but anyway, that's there as a gift for you as well. And I remind you also, if you're feeling overwhelmed, this picture, so what's happened over the last 2 days is really just showing you, like, you didn't even know that the bike existed. Now you know the bike existed, and you're like, oh wow, there's a whole bunch of stuff I don't know. But don't worry, we're going to hold your hand, and we're going to kind of take you to, through this journey in terms of this process. So we'll literally take you on this journey of where we're going. So I wanted to share with you something that I'll talk about tomorrow, and that's our Wealth Hackers. And in our Wealth Hackers, I've shared with you 2 resources today. I've shared with you our Wealth Going Global. So if I go back here quickly, I've shared with you our Wealth Going Global, which is our 6-module course where everything we've been through today. So how do you find the right countries? How do you find the right currencies? How do you find the top 15 assets? That's all in here in our Wealth Going Global course. So you can see here countries, currencies, assets, partners, and times. Everything's here. And then if you go to our asset mastery, then that's also here. And then you've got all the different assets. So the top 15 assets plus the partners. And that is all literally going to be in our Wealth Hackers. Now, I'll talk more about the Wealth Hackers tomorrow, but hopefully you can see today that I've just touched the tip of the iceberg. Like literally, like in terms of the depth and the substance below, like that's why we created Wealth Going Global, so that you had the substance below. And I'll share with you tomorrow how you can get access to that. But in simple terms, you'll discover how to build a globally diversified passive income safely and simply without making the mistakes that most people make when trying to do it themselves. So this is the real key. And obviously, we've given you the sheet, and I've given you enough information and with the resources to be able to fill it in for residential. But if you're wanting to do it for commercial and for alternative assets, then we've built Wealth Going Global to enable you to be able to do that, in terms of that process. But I've got something that's super, super exciting for you. So I want to share my screen with you here, and don't leave now, because this is something that was probably our biggest breakthrough in the last decade. So let me share my screen here quickly. So just give me 2 seconds. Yeah, so you should all be seeing my little picture, basically. So in simple terms, what we sat and we said, listen, you've got all this theory, you've got all this information, you've got access to the right partners, but this is Jill and Joe Soap, and they're sitting here and they want to invest in a property. So let's just for now say this is a house or an apartment in England, and they want to be able to make money while they sleep. I mean, that's the objective. Like, how do I make money while I sleep? Yes or no? Like, help me out so far. Am I right in terms of my little picture of what people want? I mean, ideally, you're lying in bed, you've got an asset, and it's making money while you sleep. Yeah. So you come on a course like this, you read a book, you join a mastermind, you find a coach, whatever, like you get a degree, you go to university, etc. And you do all of this stuff, and you stress 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 and you buy lots of houses like me. I bought 16, and you stress and you stress and you stress, and you just don't seem to be getting to the objective. You just don't seem to be making money while you sleep. And so we set ourselves a challenge, and we said, how can we help anyone, Jill or Joe So, go from A to B as quickly as possible? How can we help them create passive income as quickly as possible? And we set ourselves a target, and we said, how can we do it in 30 days? 30 days or less. Now, that's quite aggressive. And some people are going to say, oh, yeah, no, but Scott, that sounds too good to be true. And so I'm a big believer in life that if you ask great questions, you get great answers. And so what we basically decided to do was to create a challenge for ourselves and effectively say, right, how could we help people get passive income in 30 days? And so we built a challenge. And what this basically allows you to do is unlock your passive income stream in less than 30 days. So our next challenge starts on the 15th of January. So that's next Wednesday, to be exact. It'll help you achieve your passive income with expert guidance, step-by-step strategies, and community support. And you can secure your spot now. I'm literally going to show you how to do it. Now, there's a special offer just for this challenge. So for the people that sign up on this challenge, you're going to get access. So you've got until Friday. So because we're running the challenge until Friday, you've got until Friday to register. And if you do, you're going to get access to a bonus webinar. Okay? In terms of process. So we're doing this specifically as an exclusive offer, a special offer for the challenge. Why join the challenge? Well, the first thing is that you're going to get results in 30 days. So achieve passive income within just 1 month. So all the theory that you've listened to for the last 2 days, imagine if you could get a result in 1 month. Earn money while you sleep. So this whole proverbial make money while you sleep. Well, imagine having your money work for you 24/7. This challenge is designed to help you achieve just that. Step-by-step guidance. Have someone actually helping you hold your hand and walk you through the entire process, from setup to seeing your income flow into your wallet. And then each week, there's 4 weeks in a row. Each week, step 1, step 2, step 3, step 4. Just follow the steps in a systematic, formulatic way to be able to get the results and make it easy and achievable. And then finally, community and accountability. Join a group of like-minded people so you can cheer each other on and you can stay motivated. Like, I don't know about you, but when I'm wanting to train for gym or, a diet or anything like that, I find it really helps if you're part of a group of people that are motivating each other along. And if others are doing it, it inspires me. And sometimes I'm inspiring them and, et cetera, in terms of that process. So what is it all about? Well, the goal is to set up and start earning a passive income in 30 days. The start date is the 15th of January. And the outcome is the participants complete all the steps and have a passive income flowing within 30 days. Now, I'm not going to go into all the detail, but I just want to give you an overview. So day 1 to 3 is about onboarding and goal setting. So this is establishing participants' mindset, building excitement, and setting clear financial goals. The activities are a kickoff webinar, setting a personal financial goal, joining the community group, and sharing 3 reasons why passive income is so important. And the outcome is participants are motivated, clear on their financial goals, and connected with the group. So that's how we get started. Then it's step 1 and 2. So this is about signing up on the platform, completing your KYC, which is knowing your client, and setting up your wallet. The objective here is to get participants technically ready to receive passive income. So, it's one thing to mentally get ready. Now it's actually getting ready on the platform. So you do the KYC setup, you do the wallet setup, and you submit your proof of KYC and wallet setup. And the outcome is participants are verified wallet and KYC ready account for transactions. Next, step 3, identify your investment opportunities. So start to look at the different investments on the platform and fund your wallet. The objective, guide participants to research and selective passive income deals. The activities are you start to look at the different types of deals. We've been going through that today. You start to identify one or two deals, and most importantly, you fund your wallet. You actually put money into your wallet. Outcome, participants have funded their wallet and looked at their investment strategy. Next, step 4, make your first investment. Get participants to execute on their first investment. So this is where you guide it through in terms of your first investment. You make your first investment. There's a Q&A to answer any questions that you got. And then every participant has completed their first investment. So that's what you're wanting. And Karoon, your minimum investment is $10. Then it's tracking results and optimizing your strategy. So help participants monitor their passive income flows and identify ways to optimize. So this is a tracking session. Now you start to look at your wallet and actually see what it's like to have money coming in. And then, share your results so that you can start to set up new goals. Participants understand how to monitor their income and optimize their future growth. And then finally, celebrate and plan for the future. So celebrate your wins and set up participants for long-term success. So this is where you have a virtual celebration. You plan for your next step, your goal, and ultimately your outcome is that participants feel accomplished, celebrate their success, and have a plan for continued income growth. And if you already have a profile, yes, definitely you can qualify. So that's the detail. If you want to look at it as a summary, we literally break it down by setting your financial goals and joining the group. Then step 1 and 2, signing up on the platform and getting your wallet set up. Step 3, funding your wallet. Step 4, making your first investment. And then ultimately tracking your results and celebrating. By following these steps, you'll unlock your passive income in just 30 days. Maybe you want to screenshot that as a vision board, because literally our logic is to take away all the noise, take away all the overwhelm, and to help you get a result in 30 days. Who's this challenge for? Well, aspiring investors, new to passive income and want to learn the ropes. Seasoned investors, looking to explore new opportunities and strategies. So maybe you've got lots of money, but you actually want to start investing in Europe or America or England, and you want to start diversification. And busy professionals. So people who are very time poor and they want to earn the passive income, but they want very minimal day-to-day involvement. So this is about keeping it really simple, really quick to be able to get results for you. Some of the tools you'll get, well, you'll get the KYC and wallet setup, weekly webinars. So every week, Alex and the team take you through it in a live session to answer any questions you got. Community chat, you get a certificate upon completion, and advanced webinar access for early registrants. Couple of milestones. Well, milestone 1, you get your KYC and your wallet set up. Then you get your first investment made. And then you get to track your income in terms of where we're at. And then finally, your FAQ. What if I've never invested before? No problem. The challenge is beginner friendly and offers step-by-step guidance. How much money do I need to participate? Start with whatever amount you feel comfortable with. We provide options for small and large. So we've got people that do $1 million. We've got people that do $10. What happens if I miss a webinar? All webinars will be recorded and shared with participants. You won't miss a thing. So just some interest. If you could get passive income, like you've whether you are 13 years old or 14, probably now, Kai, or whether you are 84 years old, this proverbial passive income, if you could be earning passive income while you sleep, how much would it be worth to you? How much in dollars would you pay to be part of a challenge to be able to get a result? And I want to tell you a story while you put it in the chat box, because I'm interested. I'd like you to think it through. But for me, there's a gentleman that Alex and I work with called Derek, and he's so excited because he got his first passive income of $6. Now, $6 doesn't change your life. It truly doesn't change your life financially, but it does actually change your life, because he's been farming for 42 years. And the only way he's made money is by working 7 days a week, digging holes in the ground and planting seeds and growing crops. And suddenly he made money while he was sleeping. And yes, it was only $6, but $6 can become $60, and $60 can become $600, and $600 can become $6,000. And so how much would you invest in yourself if you knew you would get a passive income? No one's giving me a number yet. Yes, this is a hard card. I'm interested. Like, what would be the number that you would say? Like, if I said to you, right, put down $10,000 to actually know that you'd be able to get a result, or $100,000, or $100, or $5 million. I don't know. Like, where you actually know you're going to get a result. Someone said priceless, not as much as I could afford. $5,000 to reflect the security. I'd start with 1,000, for now 6,000. So just my interest, if you look at it, so access to the weekly live webinars. So Alex runs 4 sessions, and that's valued at $250. And interesting enough, I think Alex is undervaluing himself there. But anyway, the bottom line is, he's running 4 live sessions for you to help you, to coach you, to mentor you, and to answer any questions that you've got. Then you've got the comprehensive wallet setup and guide, etc. That's $99. Then you've got exclusive access to the community. That's $199. Then you've got the advanced investment optimization webinar. That's $149. Then you got the certificate, which is $79. You got the peace of mind. I mean, what's the value to that? I don't think you can really put a value on that. And you got smart investing. So you got access to the technology, to be able to do it. And again, how do you put a value on that? But if you add it all together, it's $776. Like, that's what it would cost if you literally took our costs to be able to deliver this for you. Now, we're not going to charge you $776. And the reason we're not going to charge you $776 is we believe in Zig Ziglar's principle that if you can have anything you want in life, if you help enough other people get what they want. So you can have anything you want in life if you help enough other people get what they want. So the way these challenges normally work, like a 4-week challenge like this, would generally be priced at about $297. And we actually had thought long and hard about charging $297, but we decided not to charge $297. And we had 2 choices. We literally sat here, Alex, myself, and Shane, and actually the rest of the team. We sat and we debated it back in October. And we had quite a fierce internal debate, is a nice way for saying fight, as to what we should or shouldn't do. And certain members of the team wanted to charge for it, and certain members wanted it to be free. And anyway, we had this whole debate, like, do we just make it free and then everyone can have access? Or do we actually charge for it? Because when people pay, they pay attention. Anyway, I'm not going to say who was voting for who, although I do like to win. But the point being is that we did the first one for free. And I warned people that it'll be the only one for free because, in my opinion, I knew that people wouldn't get results. And if you look at the numbers, these are the numbers. So the first one was free. We had 352 people sign up. So 352 people wanted passive income. 80 turned up. 10 funded their wallet. 8 invested for a whopping 2.23%. Now, when you look at the world and you look at the fact that, all of the wealth is held by literally the top 1%. And if you take the next 5%, it's 95% of the world's wealth. Like, the same pattern repeats itself over and over and over again. I was hoping this would be closer to 10%, but it's nowhere near close to 10%. And why I knew this would be such a low number is for many years I've stood on stage and I've handed out free vouchers. Like, literally, I've stood at Robin Banks and Ann Wilson and Roger Hamilton and you name it. And I've literally said, here's $100. Run to the back of the room. I'll give you $100 for free. You don't have to do anything. All you have to do is go on the platform and register. And less than 1% of people used to take those vouchers and register. We literally gave them $100, and less than 1% of people actually went through. So 2.23%, we're slightly better. That's Alex. Alex, you've 100% increased the conversion by helping people and holding their hands. And so for me, I'm not interested in free, because when people pay, they pay attention. And this guy, Russell Brunson, holds the record for making $3 million in 90 minutes, selling from stage. And he just says it's an utter waste of time to do free. And I tell you why, because we're doing you a disservice. Like we can give it to you for free. We did. You could have done it in October, November for free. And the results are ridiculous, 2.23%. And so my question to you is, would you invest? I'm not going to charge you 297, but would you invest 297 if all it could do was help you achieve passive income in 30 days? Yes or no? Just type in the chat box or think it in your head. Would you invest $297 in yourself if you knew that you would earn a passive income in 30 days? I can see yes, 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 yes. I would find the money. Yep, yes. And what about if this could help you find a way to make money while you sleep? Would it be worth $297 to you? What about if this could make your money work for you 24/7? Would it be worth $297 to you? What about with Alex holding your hand and making it simple, safe, and doing it as quickly as possible? I mean, this used to take me months, if not years, and now we've got it down to helping people do it in 30 days. Would it be worth $297 to be able to go through the whole process, have someone hold your hand, and have it done within 30 days? And you actually see a tangible result. What about if it could save you time and give you back time? You know, I mean, often people come to us and they say, "Oh, Scott, Alex, I can't join. I don't have the time." It's like, well, if you don't do this, you're never, ever going to have the time. And lastly, probably in my opinion, the most important one is what about the peace of mind? Like the peace of mind to know that it's actually possible, that getting to freedom is possible. You won't be financially free. I can promise you in 30 days you won't be. Let's be very, very clear on that. But if you had the peace of mind to know it was possible, would that be worth 297? So I just remind you what you get. You get access to the weekly live webinars, 4 weeks in a row with Alex, lunchtime on a Wednesday, a comprehensive wallet setup. You get exclusive access to the community. You get advanced investment optimization. You get the certificate. You get the peace of mind, and you get the smart investing. And the whole thing is valued at $776. And we don't charge $776. We've actually made it a ridiculously low number, but still a number, because when people pay, they pay attention. So we are actually helping you help yourself by making an amount of $97, so that the 353 people that signed up for free, we would rather have 100 people that sign up for 97, and then they've made a commitment, we make a commitment, and we do what it takes to help you get a result. So if you're interested and you want Alex and the team to hold your hand, 4 weeks, it's starting on the 15th of January. If you sign up by the end of the challenge, you're going to get a bonus session as well. You literally go along to the link, diversificationchallenge.com/passive income. For Shauna and Alan and some of the Mastermind members, you don't have to worry. Alex is on your team. You're already in first class. He will bring you the champagne and help you do this anyway. So you'll get free access to it anyway, so you don't have to worry about that in terms of that process. But to the rest of you that are not part of the Mastermind, this is your way to literally get started this year, 15th of January, whatever the exact date is, I don't know, but by the 15th of February, you're actually getting results. And Nomonde, yes, if you've got an existing profile, fantastic. This is just a 4-week process to hold your hand, to get you started, to fund your wallet, to get your deals going in terms of that process. So, it's literally $97. We hold your hand, And we're asking you for a financial commitment because when people pay, they pay attention. And Alex, I know that you feel the same way as I do. We would much rather less people pay and do it, but we get a conversion rate of 80, 90, 100%, than a piddly 2.23% from people that are free. Anyway, over to you, dude. I've done too much talking.
Sorry, Scott. I was just trying to find the link in the Google Doc to make sure that everyone has the right link. Yeah. So I've known the numbers for a while now, and I think I've been in denial because I didn't want to accept it. Because throughout the entire challenge that we hosted last year, every single session that I had, I was like, okay, guys, I've got a bet with Scott, a case of beer. If we get to like an 11 to 12%, conversion rate, I win and he loses. And unfortunately, the number speaks for themselves. So yeah, it is saddening to see all those efforts and all that hours of time spent with people didn't actually result into, action. So I'm 100% with you on this in terms of when people pay, they actually pay attention. And it's not about, monetizing this thing or actually, the amount of time that we spend from this. This is actually making sure that people take this seriously, because everyone always wants to join us on webinars and, they get all excited and they educate themselves. And then within the next 2-3 days, it's of a memory, and no one actually takes it seriously. So yeah, I'm excited for next week. The people that is going to be joining me, we're going to be a little bit more aggressive in the way that we did last year. So WhatsApp group reminders, literally, we'll take the horse to water and we'll push the head underneath the water to make sure he drinks. And I'm excited to actually kick off this year strong in that sense. So I know that a lot of our mastermind members are going to join us that joined us last year. So again, as Scott said, that's all included already. So yeah, we're going to have already about 15 people join us from that point of view. And looking forward to everyone else that's keen to join and actually take this seriously.
Awesome. And Richard, I love what you said. Yeah, this is so easy, well thought out and process that works. So I really appreciate that. And yeah, look, we've I mean, credit to Alex and the team. They worked really, really hard at just making it simple, easy. We always say that internally that Scott talks too much. So it was like, right, let's have something that's opposite to Scott talking so much and actually just going straight to action. So, and in terms of the timing, I think it's 12 p.m. SAST, South African Standard Time, which is 10 a.m. UK time every Wednesday for 4 weeks. It is recorded. So if you need to watch it in the evening, so be it. There's a community chat group so you can chat as well to ask questions. So we've tried to remove all the barriers to entry. No time, no money, no knowledge. We've kind of solved all three of those. And for in Essentia, she said, how long is the prize valid for? Well, the next challenge starts on Wednesday next week, so the 15th of January. And it's a 4-week process in terms of it. So yeah, it's just a special offer that we're giving for this challenge in terms of that process. Richard said, don't be disheartened. Yeah, look, Richard, the bottom line is just, he spoke about the little bet internally. It was just, I said we should have charged right from the start, but it's just one of these things where it's just free doesn't work. People don't pay attention, and that's why it's far better when people pay attention to do it. So look, I need to wrap up for today. So the link is there. Alex has put it in. Maybe Alex, if you just want to put it in again, if people want to join us, there is limited space as well. So because it's going to be paid for, we want to make sure the team can really facilitate, etc. So there is limited space. So the sooner you join, the better in terms of that process. And then just lastly, a couple of comments around the passive income challenge. There is a way to get involved. If you say you don't have the money yourself, you can actually refer friends and be able to get. So just a mindset, if you're business mindset and you investor mindset and you're like, hey, I can refer friends, etc., then all of you can win. It's Zig Ziglar's principle. If I can help enough other people get what they want, I can get what I want. So just a concept there. The second thing is that, our objective is we want to actually help people win. And then we want testimonials because we want to show that it works. So that's what we want. We being honest right up front in terms of the process. And then also people only get one chance at this price. So the 353 people that signed up had the chance at free. Free's gone. At $97, they'll get one chance at 97. If you pay 97 and you don't do it, the next time it'll be 297. The next time will be 997, and then after that, we won't offer the opportunity again because it just doesn't work like that. And then lastly, we can't tell you what to do, but there's specific deals that pay out monthly versus quarterly or annually, and so it will be important to invest in a specific deal like ABF to be able to actually get the result within 30 days in terms of it. So, so Z, it's all about getting your income within 30 days. So getting your distribution within 30 days, you receive your distribution. So let's wrap up for today. The action steps, reminding you, silver is compulsory, gold is bonus. So your silver is fill out your top 5 countries. So again, go to your sheet and fill out your top 5 countries. Go to your currencies and fill out your top 5 currencies. Then go to your assets and fill out your top 15 assets. If you're not sure, copy from me. Consider joining the Passive Income Challenge. What is the point of all the theory if you don't get results? So that's why we've literally made it as affordable as possible to literally help you get results, get started, get results. And then lastly, go to the community, the Wealth University. So if I go here and I go, and you can see day 2, and there's your day 2 key takeaways, and you can literally go in and you can put in your different takeaways from today, ideas, etc., etc., etc. Okay, in terms of that process. Awesome. And then your gold, which again, when you've got time, is you can go and watch Ann Wilson. She's another one of the, well done, someone's just joined the Passive Income Challenge. So whoever you are, congratulations. Go and watch Ann Wilson. And then also there's a link there to a risk tolerance questionnaire. It's just one that I found. I'm not saying it's the best, but it just helps you understand your risk tolerance. Again, for our Mastermind members, we actually do something called the Enneagram of Wealth, which I'll talk more about on, I can't remember if it's tomorrow or Thursday, but that actually goes into risk and everything always in terms of that overall process. And someone actually asked me about explaining the different offerings. I will talk more about the Mastermind on Thursday. I think Max, you asked, I can't remember who it was. Okay, and then you've got the next steps navigator in terms of the next steps and what to be able to do. So thank you very much. James, thank you for the kind comment. Scott always over delivers. He gave 17 assets for the price of 15. Have I messed my numbers up there? I need to go check. Anyway, that's classic. And then the prize winner for today. So interesting in terms of the prize winner for today. And I know that Alex has already offered it to Mama Dupi. So Mama Dupi, I know that you've been already offered the upgrade to join us in the VIP. So we look forward to seeing you in the VIP. And for those of you that still want to join us in the VIP, come and join us. You can literally go to the link. Alex will chuck it in the chat box for you. You can just join the VIP upgrade in terms of that process, in terms of where we're at. Okay, and lastly, the homework competition. Just remember, you can always win prizes. You never know what tomorrow's prize will be if you join, and put your homework in. And it's now time for the Q&A, where I go in and I answer any questions that I've got for the VIP members. Reminding you what you get as a VIP. You get the at least an hour of coaching every day. You get all the replays. You get the VIP sessions, and you get the first module of Wealth Going Global for free. So it's kind of a no-brainer financially. And you might notice, just like the Passive Income Challenge, we charge small amounts of money because we just find that when people pay, they pay attention. And honestly, I just prefer working with people where there's a mutual exchange because they're the ones that get results. You can join the WhatsApp group if you haven't done it. Join the university group if you haven't done it. I'll remind you that this is the formula. You diversify across countries, currencies, assets, partners, and time. Today, I showed you residentially how to do countries, currencies, and assets. And tomorrow, we're going to talk all about how to build up an asset allocation. On Thursday, we're going to figure out how to find the right partners. And on Friday, we're going to build a plan over time. In simple terms, it comes down to two things. You need the right information and you need the right partners. We've given you the passive income challenge. It's literally the simplest way that we have found to help someone within 30 days go from A to B to be able to earn a passive income. And so join us. It starts on Wednesday next week, and there are limited spaces available. And for those of you who sign up before the end of the challenge, you also get access to the bonuses. And so the plan for day 3, it's how to build a globally diversified passive income. So it's how to build a diversified portfolio. So how do you actually, put the different parts of the portfolio together? And as Nelson Mandela said, money won't create success. The freedom to make it will. Time for the Q&A. To the people that are part of the VIP, to the Wealth Hackers and the Mastermind members, I will see you in the VIP room. If you don't have access to it, just remember that you can email support at Wealth University. You can chat to Alex here, or better still, hopefully you're already on the WhatsApp, and we'll just post the link there in terms of the process. And I want to just say thank you to everyone. It's always a privilege for me and Alex and the team to share with you. I know today was a hell of a lot of information. I do apologize for the amount of information. I don't really know how to do it any other way because there's so much to share, and I want you to be empowered, and I want you to have your eyes aware of what you need to know. And whether you don't know it all, that's fine. I learn stuff every single day as well. But what is truly important for me is that you understand what the top 1% are doing. You understand the type of investments they're making, the partners they've got, the knowledge they've got. And hopefully today, if nothing else, I've shown you how you don't have to know all the knowledge yourself. You can literally copy and or partner with them in terms of that process. So I just want to see quickly. Yeah, I'm not sure exactly what he was talking about in Canada. I think he was talking about Canary Wharf. So he was talking about Canary Wharf in London, which is the financial capital of London. And and Lisha, if you can just chat with Alex directly, he'll be able to help you with regards to Kai. Thanks for all the kind comments. I see Alex has put his number in there. Okay, awesome. I think that's everything for today. To the VIP members, to the Wealth Hackers and the Mastermind members, I'll see you in the Zoom room. Thanks, everyone. Have a wonderful day. See you tomorrow. Tomorrow is a super powerful day with the family office. So make sure you come along, bring your friends and family, because trust me, tomorrow is the day that you want to know about asset allocation. Cheers, everyone.